mentioning your name, institution, and then the name of the speaker you're proposing the questions to. All the questions can be submitted in English and Bahasa Indonesia. We also provide the interpreter feature, so please select the languages that you need translating for. Thank you, and we hope you enjoy today's discussion.
OJK memiliki visi dan komitmen yang kuat dalam pengembangan sumber daya manusia sektor jasa keuangan secara berkelanjutan, guna mendukung terwujudnya industri jasa keuangan yang stabil, kontributif, dan inklusif. Kami sadar, dalam mewujudkan visi tersebut, peran SDM yang unggul dan kompeten menjadi kunci utama. OJK Institute hadir untuk menjadi Center of Excellence, guna mendukung pengembangan sumber daya manusia sektor jasa keuangan dan melakukan riset-riset yang inovatif dan terkini. Pengembangan sumber daya manusia sektor jasa keuangan yang kompeten dan profesional menjadi salah satu faktor penting dalam mendukung keberhasilan kinerja lembaga jasa keuangan. OJK Institute memiliki 3 fungsi utama. 1. Mengembangkan kapasitas SDM sektor jasa keuangan melalui penyelenggaraan program pelatihan, seminar, dan workshop. 2. Melakukan riset yang inovatif dan visioner. 3. Merancang dan mengembangkan standar kompetensi SDM sektor jasa keuangan, serta melakukan penata laksanaan lembaga sertifikasi profesi. Dalam rangka meningkatkan kompetensi SDM di sektor jasa keuangan, OJK Institute menyelenggarakan berbagai program capacity building, baik dalam bentuk workshop ataupun webinar. Menghadirkan narasumber terbaik yang memiliki keahlian di bidangnya, antara lain bidang perbankan, pasar modal, IKNB, teknologi digital, dan lain-lain. Riset di OJK Institute berbasis akademik dengan memperhatikan perkembangan terkini. Penyusunan riset menghasilkan temuan dan rekomendasi yang mendukung kinerja sektor jasa keuangan. OJK Institute juga menyediakan perpustakaan digital e-library OJK yang mengelola koleksi buku digital, koleksi internal OJK, koleksi buku fisik, dan koleksi e-resources mitra OJK. Selain itu, manfaatkan juga aplikasi LIBF OJK untuk membaca e-book melalui smartphone. Minisite OJK Institute tersedia sebagai portal media digital untuk mempermudah publik mengakses berbagai informasi kegiatan OJK Institute terkini. Selain itu, OJK Institute juga membangun knowledge management system sebagai media pembelajaran dan pertukaran knowledge secara digital yang dapat diakses oleh seluruh SDM sektor jasa keuangan. Indonesia saat ini telah menerapkan strategi pengembangan SDM berbasis kompetensi. OJK Institute bekerja sama dengan instansi-instansi terkait dalam menyusun suatu standarisasi kompetensi yang disebut dengan SKKNI, yang kemudian diturunkan menjadi KKNI. SKKNI dan KKNI dimaksud digunakan oleh lembaga sertifikasi profesi atau LSP dalam penyusunan skema sertifikasi, pengajuan rekomendasi, dan pengajuan pendaftaran ke OJK. Selain 3 fungsi utama tersebut, OJK Institute juga berfungsi sebagai license officer, praktek kerja lapangan, visit OJK, penelitian mahasiswa. OJK Institute memfasilitasi program praktek kerja lapangan di lingkungan OJK bagi pelajar dan mahasiswa. OJK Institute juga menerima kunjungan lembaga pendidikan yang ingin memperluas wawasan bidang tugas dan fungsi OJK serta sektor jasa keuangan. Selain itu, OJK Institute senantiasa memfasilitasi mahasiswa dalam hal penyediaan data atau informasi terkait dengan tugas dan fungsi OJK. Dalam rangka mendukung pengembangan SDM sektor jasa keuangan, OJK telah menerbitkan Cetak Biru Pengembangan Sumber Daya Manusia Sektor Jasa Keuangan 2021-2025 pada 25 Mei 2021. Cetak Biru tersebut memiliki visi, yaitu mewujudkan SDM sektor jasa keuangan yang profesional, berintegritas, dan berdaya saing global dalam rangka meningkatkan kinerja sektor jasa keuangan. Visi tersebut dijabarkan dalam 4 pilar misi, yaitu 1. Mengembangkan standarisasi kompetensi SDM. 2. Mengembangkan metode peningkatan kompetensi SDM. 3. Mengembangkan infrastruktur pendukung pengembangan SDM. 4. Mengembangkan SDM yang memiliki kompetensi digital. Implementasi cetak biru ini kemudian dituangkan ke dalam 21 program kerja yang akan dilakukan dalam kurun waktu 5 tahun dengan melibatkan peran aktif dari industri, akademisi, OJK, dan lembaga lainnya. OJK Institute memiliki komitmen yang kuat untuk melaksanakan cetak biru tersebut bersama-sama dengan pengawas, industri, akademisi, dan pemangku kepentingan lainnya. Cetak biru tersebut diharapkan menjadi kerangka acuan dalam mendukung pengembangan SDM sektor jasa keuangan. OJK Institute, Center of Excellence.
Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, salam sejahtera, Om Swastiastu, Namo Buddhaya, salam kebajikan, salam sejahtera untuk kita semua. To start, allow us to extend our warmest welcome to the Honorable Deputy Commissioner of OJK Institute, Bapak Imansyah, the Head of OJK Institute, Bapak Agus Sugiarto, the Director of the Financial Services Sector Development, Bapak Hikmah Rinaldi, our partners and speakers from the London Institute of Banking and Finance, Dr. Francis Lau, PhD, CFA, FRM, and Mr. Brendan Lagrange, and leaders and employees of OJK and leaders of the financial services industry, Financial Services Industry Association representatives, and all distinguished guests, ladies and gentlemen. We'd like to welcome everyone. And today we'll be talking about an array of topics on enhancing financial performance through data analytics. And to start, please allow me to extend our profound gratitude and sincere thanks to everyone for your participation and for your attendance here today. Ladies and gentlemen, what a great crowd do we have today. And to count, ladies and gentlemen, there are approximately already around almost 7,000 people who have registered to join today's webinar. And the majority of you have come from the banking sector, around 46.3%, and non-banking financial industry, around 27.4%, and others around 8.8%, OJK around 2.6%, academician around 4.2%, and capital market sectors almost 5%, and government agencies also 5.4%. And before we begin, ladies and gentlemen, allow me to run a quick brief of our agenda today. So our opening remarks will be delivered by the Deputy Commissioner of OJK Institute and Bapak Imansyah. And then a presentation and discussion led by me, yours truly, your moderator. And then to be followed with a Q&A session and then closing statements from our speakers. So without further ado, to start our webinar, ladies and gentlemen, it is with the greatest pleasure and honor for us to welcome the Deputy Commissioner of OJK Institute, Bapak Imansyah, to deliver his welcoming remarks.
Thank you, Ms. Amelia. Distinguished speakers, Dr. Francis Lau, PhD, CFA, FRM, and also Mr. Brendan Lagrange from the London Institute of Banking and Finance. Also, Ms. Amelia Yahya as our moderator today. Pak Agus Sugiarto, the head of the OJK Institute, as well as my colleagues from the OJK Institute. Our OJK colleague as well, both in the head office and also regional offices, association leaders and representatives, representatives from the financial sector, and all distinguished and gentlemen. Assalamualaikum warahmatullahi wabarakatuh, and a very good afternoon from Jakarta. First of all, let us praise and give thanks for the presence of God Almighty. Because of His grace, we can all join and attend virtually our webinar today with the title Enhancing Financial Performance Through Data Analytics. On these occasions, on behalf of the Board of Commissioners of OJK, we sincerely thank you to the speakers and also colleagues from the London Banking Institute and Finance, in particular Keuangan and also the others, for your willingness and your support to share the ideas of this data analytics, and as well as other issues related to how we are leverage on data analytics. Surely that your knowledge and
I apologize, Bapak Imansyah, it seems that you're still on mute.
Yeah, sorry. I would like to express as well our deepest gratitude to all participants who have joined the webinar, which is possibly take place because of this our intensive collaborations between OJK and also the London Institute of Banking and Finance. Thank you, Mr. Keuangan, and also colleagues from the London Institute of Banking and Finance. And accordingly, we can see the number of the participants, and we do very happy that they are coming both from western and eastern part of Indonesia. So again, I convey the message that hopefully that webinar today will very much come up with a lot of beneficial benefits for all of us here in Indonesia. Ladies and gentlemen, in the era of digital transformations that has developed rapid recently, the financial sector in particular has undergone fundamental changes in business processes, particular how they are facilitating their services to the customer. And I do realize that both banks and non-banking financial institutions are facing right now with new challenges and wide open opportunities through the use of digital technology. In this context, I think an intelligent and database approach is needed to deal with this dynamic. It is inevitable that data has now transformed into valuable assets that not only goes beyond financial institutions, but almost all sectors. And the ability to turn data into valuable insight is one of the important factors in determining the success of and the sustainability of the institutions, including also the financial sector. According to the Zhang Yu, Zhu, and Yang research in 2021, which was conducted on 37 banks in 6 Asian countries, it is found that the big data analysis strategy had an impact on internal processes and stability also in bank financial performance. This finding reinforces that the fact that the data analytics has a crucial role in financial sector. Analytical data integration has the potential to provide as well significant performance improvements. To my understandings, when we have this understanding on how we are leveraged on data analytics, financial institutions are able at least to identify 5 areas that will benefit them. First is new business opportunities, improve operational efficiencies, optimize decision-making processes, and improve overall profitability. And furthermore, they are also possible to predict potential fraud that may happen in their operations. So with these huge potentials, financial institutions will also face increased competitions, transition in consumer behavior in conducting financial transactions, and necessary regulation adaptable to today's digital transformation challenges. Therefore, I think a stronger approach is needed through better data analysis in the future. If properly implemented, financial institutions can have the ability to identify opportunities and then describe customer profiles from various segments, assess and minimize risk, manage portfolios, and measure performance metrics accurately. According to Statista and Gartner survey reveals that today business world tends to adopt database decision making rather than relying on intuitions. Gartner says that this is causing the data analytics market to grow at a compound annual rate of nearly 30% or over $329.8 billion US. So it's a great number. And I think the trends indicate that the way ahead, companies will shift their business and they will transform into also how to leverage on data analytics. Further, when we have this, the way that we understand the big data, the data analytics with a very large and complex data, I think, of course, it will take a long time and cost a lot as well. But the benefit that it can gain through this data analytics is, I think, so they have this something that they cannot have from the traditional approaches. But with this data analytics, they can go further to the adoptions of artificial intelligence and also machine learning. And this will put them into data-driven decision making. Ladies and gentlemen, and all participants, OJK has seen these areas, and also I think one way that we done already is that we have tried to our initiative, develop our initiative as well to use the data because we having the data comes and report by the financial sectors. So now we are trying to move our supervision framework and our development framework based on what we call this technology-based supervisions or supervision technology or subtech. And I think just recently, OJK has issued a policy, namely OJK Subtech Integrated Data Analytics or OSIDA, a platform that uses automated integrated data analysis to detect weaknesses in our financial sector business processes. So I think in the future, we try to our best as well, and we try to enhance this OSIDA with us, and hopefully that we can respond to come up with a broader policies and having also a strong commitment to encourage innovations within our OJK that adopt digital technology in various aspects to better supervision to the financial sector. And I think at the same time, we try to maintain our financial sector performance. Distinguished ladies and gentlemen, and all participants, I mentioned already about benefits that we can have from the data analytics, but when we engage with new sectors, new business, I think it is obviously that we are also having new risks. So I think with this webinar, not only a positive side of, but we try to identify also any kind of risk that related into the use of data analytics, the use of data. And I think then the speaker will come up with like any kind of mitigations practices that we can have and try to reduce potential risks that may arise from the use of data. So that I think things that I want to welcome you all, and I want to end my remarks here. But before that, I think again, on behalf of the Board of Commissioners of OJK, we do appreciate and we do thank you for all the speakers and also colleagues from the London Banking Institute and Finance and all participants, and in particular colleagues from the OJK Institute. We do have that we can have a lot of insight, and also we can enhance our understandings on these practices, on how we are using this data analytics. And then for sure, we try to having also this webinar and our collaborations with London Banking Institute to continue in the future. So I think that's all I can share at this moment. Thank you again on behalf of the Board of Commissioners, and for all participants, be active within the discussions. You can ask the speakers who are expert in their field from the London Institute and Banking Finance, and hopefully they will willing to share their experience and knowledge on these topics. So that's I can have from my welcoming remarks this afternoon. Thank you again, and have a very fruitful webinar. Thank you, and back to Ms. Amelia Yahya. Thank you.
Thank you very much, Bapak Imansyah, for such a warm welcome and great insights. And we understand that you have a tight schedule today, Bapak Imansyah, and need to step away from the webinar due to prior commitments. We are truly so grateful for the time and expertise that you have shared with all of us. And ladies and gentlemen, I'd like to once again remind you that we'll have a Q&A session after our speakers' presentations. You may type your questions via the Q&A feature by mentioning your name, institution, and then the name of the speaker you're proposing your questions for. And at the end of the session, we'll be sharing a feedback form on the chat feature. So please complete the feedback form the latest by Friday, September the 1st, as a requirement to get your webinar e-certificate. So ladies and gentlemen, let us start with our first speaker. Allow me to tell you a little bit about our first speaker of the day, Dr. Francis Lau, PhD, CFA, FRM, from the London Institute of Banking and Finance. Allow me to read his resume for you. So ladies and gentlemen, Dr. Lau is a seasoned financial services practitioner and a professional trainer. He has 20 incredible years of expertise in business planning, data analytics, financial modeling, regulatory compliance, and risk management acquired from working for multinational financial institutions and information providers. Dr. Lau is a subject matter expert in applying data analytics to enhance quality of business decision-making, building enterprise data analytics framework, developing quantitative models to gauge portfolio performance, and streamlining the management reporting processes. On top of industry experiences, Dr. Lau is also passionate in training, as he is a well-recognized trainer in data science, finance, and sustainability. Dr. Lau, we're indeed so incredibly honored to have you here with us. The time is yours.
Hi, everyone. So nice to meet all of you here, and once again, thank you for having me to have this sharing with all of you. Okay, so I have shared my screen. Yeah. Is it okay to see my screen? Okay, so today I have the honor to share this topic on enhancing financial performance through data analytics. And as Amelia has shared my background a bit, and of course, during the presentation, I can talk more about with my experience with all of you, and definitely a really
Dr. Lau, we apologize. I think the previous screen sharing was still pitch dark.
Is that okay?
Yes, we can see your screen now. Thank you very much.
Okay, yes, this is the deck. Okay. Yes, so thanks for that because and good to talk with you on this topic. And today, because of we have a quite rich content, I try to share with you on some high level understanding. First of all, I start with the market, and then I talk about some analytics technique for banking, and then for some of the value contributions because the topic is called enhancing financial performance through data analytics. I definitely give you some examples which illustrate the use of data analytics by banks and then to get incredible results. So this is what I'm trying to share today. And of course, as Amelia has mentioned, we have a Q&A sessions. And I really want to make it interactive to, if you have any questions, and please post to me and also to my another speaker, Brandon, which we will also share his viewpoint on this topic. Okay, so before I start my presentation, I want to ask to know more about your background because we have over 4,000 people on this webinar. I really want to take a poll now. Can we share the polling question now? Yes. First of all, yes, I want to know what kind of financial institutions, all of us from finance. So which type of financial institutions you work for? Hello? Hello? Have we finished polling? Okay, so I want to get some of your background before. It's a good statistic for us to know where you come from and also what's your background. And after that, we definitely can share the statistics from the floor. Okay, so after the poll, after understanding your profile, I want to start with my sharing on the market landscape. So because the topic is called data analytics, I really want to start with using some data to start our discussion today. First of all, with the topic data analytics, I think the important word is data. So this chart really shows you the growth in the data volume, which it pictures the data volume grow in the past 2 decades. You can see that I think there are some symbols. For example, it calls zettabytes. Not sure any of you know what is zettabyte. So I put a scale on top. So you can see that a very we are familiar with terabyte. Our computer is having, for example, some of them, or even our mobile phone is having 1 terabyte now, or 2 terabytes, very big. But nowadays we are talking about 1 zettabyte. Zettabyte is how much times you can see for terabytes. And you can see that the growth of data from about 20 years ago is about 0.1 zettabyte. But going to 2024, the estimated volume is 163 zettabyte. You know how big is the data volume? So we are talking about nowadays big data. So the data volume is telling you how big is the volume of data. So data analytics is definitely, we have a very important data, raw data, or even I would say raw materials for us to talk about. And you can see in this diagram, there is a percentage called structured. So what is the meaning of structure? You can see that the data, 160 zettabyte, 36% are structured data. So what is structured data? If I ask some of you, so I will give you some more explanation in this area. Okay, so the next diagram you can see is the share of structured and unstructured data. So this is also telling you that what is structured data? Structured data meaning that those are from the ERP, enterprise resource planning, CRM, the customer relationship management system. That means it's structured data you can think of like those in Excel, which is row columns, is very well presented. But nowadays we are talking about the unstructured data, which comprises a much bigger volume of data. You can see that structured data is about 10%, and then other 90% of the data is called unstructured data. Unstructured data is everywhere nowadays. So we have web, we have the social media, we have the mobile web, WSN. So they are all, so we are all called the unstructured data, which meaning that the variety and also the format and even the nature is quite different from what we understand previously. That means what we are trying to use in Excel and a database is really quite different. So you can see in terms of volume, in terms of the structure of data, is definitely totally different from what we are in a decades and 2 decades before. So we have a big volume of data, and so there are tremendous opportunities here. So I think just using 2 diagrams, I really want to illustrate how big an opportunity ahead of us. And when we know the big volume of data, the variety of the data, but when you ask some people, like for example on the forum, when we ask, I still remember we talk about at the opening speech, we talk about data-driven decision making. So if we pick people to ask, and then the question on the right-hand side, do you think data-driven decision making is important to your business? And from a survey, 91% of people say that that's important. I think that's a really remarkable percentage. 91% said that's important to your business or to my business from the survey. But another question, the follow-up question is, are we using data to make decisions in your business? The answer is dropped to 57%. That means only 57% of the respondents say, oh, we are using data to make decisions in our business. Do you see a big gap here? People think that is important, but seems like still a big room for us to improve or even to utilize data in our everyday business operations. So we see that we have huge amount of data, we have very big variety of data, but we are still have many rooms to utilize the data in our normal business operations. Okay, and in the same survey, when people ask about what kind of decision-making techniques contributing to your most successful projects, and you can see from these answers, 67% of the respondents said, our customer feedback is very important. And of course, the following is experimentation and testing. And then the third one is data analysis. What this answer telling you is that in terms of the usage, or in terms of applying data decision-making techniques, of course, customer, voice of the customer, and also some testing result experimentation, and also how to analyze the data is definitely of the top 3 most important application, which give you some idea. That of course the survey is done in other parts of the world, but definitely tells you that data-driven decision making have lots of room to further utilize, and also the major area of applying this. Okay, just a few slides, you can see that what the area we should focusing on. And also another diagram for you is I also picked from some market research is the growth in the digital banking market. You can see that from 2020, that means 22 last year, to 2030 in about 8 years time, the market growth from 9.1 billion US dollar to 21.8 billion dollar is a big market. Compound annual growth rate of 11.6%. So it's a big growth in the digital banking market. Why that relate to our topic is because going back to our first slide, the data volume with digital banking, we will the growth in digital banking, of course, reinforce the growth in data. We will get even more data than before. So we have more raw materials to utilize to apply our techniques in this area. Okay, another slide it shows you another growth, which is the growth in the banking analytics market, which from the same period 2022 to 2030, 5.1 billion to 11.6, nearly double in about 8 years. A CAGR of about 10.8%. So that also reinforce that. So remind all of us that growth in data, growth is also hand in hand growing in the analytics. So that is a really big area for us to explore. And from the first few slides, I just illustrate, sharing with you the growth in data, the growth in the relative share of different types of data, and also some survey to talking about the use of data in business, and also the growth in the digital banking and also analytics market, which is just a few slides to illustrate how to use data in outlining the whole market market landscape. Of course, it's just a few. If you ask me, I can continue on for another 3 hours to talk about data. But seems like for today we will focus more on sharing the applications, just to give you some idea of how our current state look like. If you agree with me on the current state, then I will move on with the data analytics for banking, which I will share with you some kind of techniques and also applications for our banking industry. And to start with, I give you some idea about analytics, which is an overview. So what is analytics? Obviously, we talk about data analytics is to convert raw data into actionable insights. The keyword is raw data. That means we have all the data from web, like as I've said before, unstructured data from the web, or from different social media, or even from our mobile devices. But these are all raw data. Most important part is we need to make it an insight. That means to make us know more, but not only to know more, is to have actions. That means if I understand what the consumers or what our depositors want, like for banks, if we know that depositors prefer what types of features, then we can provide them the appropriate products and then win their business. So this is actionable insights. Of course, for data analytics, it's not just about the data. It involves a lot of tools, technologies, processes, which help us to find the trends and also, of course, to resolve problems with the data. This is our input. It helps us, as we have said before, improve our decision making, enhance our business processes, and of course, more important is to stimulate business growth and also revenue profit growth. It gives us more understanding of our processes and also services. That's the usage of data, and of course, understand better our customers' experience and also their needs. That's always the case. Externally understand our customers, internally understand our operations. And of course, nowadays we are trying to, as as the first statement, raw data into actionable insights. So the thing we need to do is we need to connect insights with actions. That means we have data, and then how to find insights and also to derive actions from it is the gist, is the most important part. And of course, based on this, we can build new products, we can enhance customer experience, we can improve our productivity, and of course, optimize our operations to make it more efficient. So that's all the benefit, echoing the opening, those mentioning in the opening speech. So that's the realizable benefit for us for data analytics. And for me, I will focus today more on the commercial banking. You know, commercial banking that means serving like the SME, corporations, and other types of institutions. For corporate banking, we know that it's really a okay. We always talk. It's something like for commercial banking, it's traditionally a relationship-driven business. That means we focus on having RM, relationship managers, to manage the business, human-to-human contact. But of course, as we have seen, banks are now store large amount of data from different sources, and that we have methodologies and also technologies which can discover trends, of course, meaningful trends from the data. And we have many techniques and systems which allow the banks to analyze large volumes of transaction data, which we have seen before. So, we have seen now. So there are big, I would say, a leap forward in this area. And more important is with all these, with the data analytics, is of course to gain a competitive advantage sustainably over our competitors. So that's the main theme today. So we know we have a lot of data, and we know that we still have lots of room to improve our business decision-making process. And where to move on is the topic we want to talk about. Of course, within these 45 minutes for today for my presentation, I will give you some directions and from my own experience to share with you. Okay, so this is some example, I would say, some example use cases for banking. Like, first of all, we can do deposit portfolio analytics. I come from I used to work in Hong Kong and also support the Asia Pacific market. From my previous experience, some of my banks I worked before, they will understand the customer demographics, like those depositors, where they're coming from, meaning, for example, not just about gender, not just about age, for example, understanding their transaction behavior, whether they are they use the deposit account as a transaction account, or just to save the money. What's the behavior and what's the balance movement? We will understand it, and of course we will monitor the portfolio movement, and we will definitely identify the growth engine to understand which area, which factor is driving the growth. And of course, more important is we also need to know which factors drive the depositors to roll over their deposit. So these are all about deposit analytics. And for a bank, deposit is on the liability side. On the asset side, is about loans. So for loan portfolio analytics, we will understand, of course, the credit risk of the obligors, and also whether we concentrate in one or two products, or even in one of the geographical area or obligor. And we will monitor the portfolio movement, the credit performance of our obligor. And more important, nowadays, we will use that to drive pricing strategies, which is an area, which is a big one, which is we call risk-based pricing. That means we will price the product according to the risk exposure, or I would say risk profile of the obligor, to make sure that the better customers are offered better terms. And of course, we are not discriminating. We are trying to differentiate different types of customer from this. So you can see deposit, we have tools to that. Loans, we have to that. And just to show you the power of analytics with the balance sheet, that means asset side and liability side of the banks. And for strategic initiatives, we also, the banks can also apply, like we will analyze still, even though nowadays we are more on the virtual setting, we still want to understand the physical branches performance. We can analyze the performance of different branches in terms of their selling effectiveness, in terms of their product portfolio, and also the customer segment they are serving. And also we are doing good, but we also want to know when we compare with our competitors, where are we? So this is called, we will compare our KPI with our peers, with our competitors. And of course, for bank, we will rely on organic growth, but at the same time, we also actively look for new opportunities in the market. Is how the M&A market look like, that means mergers and acquisition. We also want to be using data. So everywhere we can apply data in the banking industry. Just to give you some example, hopefully today I will give you some stimulation in your thinking, how to apply data to solve your daily your daily issues on the business. And here I want to show you some value propositions, just 5 of them, because if we can talk, we can have 50 or even more to let you know. In areas like the market research for products and services, we can definitely use data to understand the need of corporate clients and to create new products and services which fit their need. For example, we know that corporate clients are now serving a global market. With this globalization, how new products can help them, which I think data can help to answer this question. And of course, we want to achieve a much higher degree of automation, because we know that human costs are increasing, and of course, humans are always subject to, we will become tired, and also we will make mistake. But with data, we know how to automate some of our tasks and also to streamline our operations. For example, some of the more tedious one, like fund disbursement or even loan underwriting, which we can rely on data to help make it more efficient. And of course, nowadays we talk about customization, because every one of us are different and we have different needs. But for many of the cases, like banking services, it's very standardized. So how to make standardization, how to make customization out of standardization? That's the concept. So we are talking about mass customization. What is mass customization? Meaning that we can use data and also to modify, to refine, I would say, rather than modify, to refine the product offerings to corporate customers based on their needs. Of course, that will happen to, we have understand their needs based on what we have got from them. So this is customization and also predictive intelligence. Nowadays, with all the data, we are not just sitting there. We can project for the futures. As we know that the buzzword, artificial intelligence, machine learning, we can make better predictions and know where the customers are heading. And so we know how to prepare for it. And of course, if we know, we have better understanding of the movement of our customers and also the market, then we can have better risk management. We can lower the risk exposure of the firm. And of course, we will see where is the likely high risk event occurring, like default, so we can have remedial actions in place. So these are, you can see data have a lot of range of applying in the commercial banking, from building new products, from automation, from offering customized solutions, and even to predict what's happening in the market to lower our risk and also to increase our growth. This is over the value chain to show you some of the applications here. Okay, and after I share for some time, you can see that data analytics has a lot of usage in the banking industry. But if you want to ask some more questions, what are can you tell me more about what type of analytics we are talking about? So usually we will classify the data analytics using four different perspectives. So on this diagram, You can see on the vertical axis, this is the value axis, and on the horizontal axis is complexity. If you look at from value complexity dimension, this is something from a Gartner presenting. So first of all, the first type of analytics we are very used to is called descriptive. So what is descriptive is used to answer what happened. That means we are looking back. Oh, so is our sales dropped? What's happening? Just to answer this, very straightforward. And for diagnostic analytics is why we want to know the cause of it. Why did it happen? Oh, the sales last month has dropped. Why it's dropped is because of some bad weather. That may be the cause. So diagnostic analytics help to answer this question. And of course, more important is we know what's happening and we know why happening. And more important is we want to predict what will likely happen next. If we know that the coming month we will have a big holiday, or we will know that there are some events happening. So how will that impact our business? I think that's something we want to know about is prediction. And after we know what will happening, then more important is called prescriptive analytics. So what is prescriptive is how can we make it happen? For example, if we know that there's some big event occurring in Indonesia, so how can that connect to our business? I think that's what trying to answer by prescriptive analytics. Hopefully that's give you some idea of we have in our toolbox 4 types of analytics, which help us to understand in the past what happened, to why did it happen, and what will likely happen next, and how can we make it happen. So this is important for us to apply to understand. And of course, if you really want to start your analytics process, so how will that looks like? I put it in 6 steps. It's the 6 steps. First of all, of course you need to define your goals. What will be your goals? Like I want to increase my business by revenue by X%. Okay, so you of course that's already include defining the KPI like revenue growth by X%, and that means that the goals is to increase your business volume. And of course, after you have the goals and also KPI, you need to collect data. For example, from your customers or from the market, you need to get all the data available. And after you have all the raw data, you need to analyze. You need to understand what's happening, the pattern. And after you know what's happening or what's in it, then you can propose solutions. We call test alternatives. We can have some campaign, or even you can have some test options to see how it looks like. After that, then you can implement. Then you can really get to action. So that's the process of getting from data to actions. So this is a very typical process, which I believe is really helpful to all of you to understand to understand how to make use of data to help you to solve the problems. Okay, so in this sharing session, I talk about for example, to outline the market landscape for all of you, and also to talk about explain what is analytics, and also some of the applications in our banking industry in the commercial segment. And last but not least, I also want to share about the value contributions, data analytics, how that contributes to your business. Okay, so I put down here some I call success stories. Success stories meaning that actually you can see they are 3 banks, which is real cases, but of course I won't mention the name, which cover from the whole customer journey from acquisition to cultivate the relationship and also to prevent them from leaving. Okay, the first case, that means I can call it Bank A. Bank A is about acquiring new customers. Of course, all the banks, like those like all of you are using conventional analytics to analyze internal data, which, for example, you will look at your internal customer base and then look at who are the most who are the highly potential customers and who are the most profitable customers from internally. But nowadays, we definitely want to know more from outside. What is outside? Meaning that, as we have talked about, we have big amount of unstructured data, like from social media and also from the web. For example, from the web traffic, we want to understand which type of customers visit our website and what their needs are, and also what the sentiment of them looks like. There is an analysis called sentiment analysis, which is quite useful to understand whether your customers have their preference towards your brand and also to other banks. With that, understanding the external data, combining with, of course, internal data to verify what's the customer's need. Then for this bank, you can see the result is increase the conversion of prospect by 7 times. I think it's a remarkable change. That means if you just look at your own internal data, you find some customers, and then you can approach them. Likely because you may not get to the right person, or you may not give them the right offer because you do not have a very in-depth understanding of them. But if we combine with external data like their internet behavior, like the social media behavior, like other profile, then we can understand better. We can give them the right offer at the right. We always talk about the right person, the right offer, the right time. If we can do it, combine them together, then you can acquire new customers and drastically increase your conversion rate. This is the first case, very remarkable. The second one is also very important. Is after you acquire a customer, they become your they are part of your existing customer base. Then how to increase your share of wallet? That means how you want them to buy more from you. They open an account with your bank. How to make them put more money? How to make them open other products for your bank? So you need to have a very structured analysis of their behavior. So that bank that I call Bank B, they analyze the data input from their 1.5 million customer records, which have many attributes. Here is just about 40, so they have their internal customer base, and then of course have quite a big number of customers, and then they analyze the behavior. And what's that looks like? And you can see that the result is 10 times increase in sales and 200% growth in conversion rate for the product in scope. So you can see it's also another remarkable story for all of us. 10 times increase in sales, 200% increase in growth rate. Do you want to achieve this? I think the answer should be yes. If you are working for a bank and you have a headache in how to grow your business, that will be some example for you. But of course, here we don't talk about what the analysis is about, and also we don't talk about how we do it. Of course, because today is stimulating. I share with you there are real cases happening. Just through analyzing internal customers' behavior, you can get this result. How to achieve it is, of course, we need another more in-depth discussions to explore that. And the third one is, of course, after the customers in your database, they are existing customers. You are really you don't want them to go. Of course, customer attrition is definitely another big topic for us. And for this Bank C, I call it, they analyze 2 million customer records, which even bigger. They have 200 plus variables. That means they have much bigger customer data volume. And then for that, they build scorecards and also using machine learning models to predict, actually this is to predict the behavior of the customers, whether they will identify which customers are likely to go. For example, after analyzing the database, you will know whether Francis or even other people are likely to leave the bank. If that's the case, then here is the result. They have an early identify cancellation risk. That means they have some alerts. They can generate some alert. Oh, Francis is highly likely to cancel the card of the bank or to close the account for the bank. So how to avoid that? because that will be that will mean a outflow of fund. So with these in place, the early identification and this avoid the outflow of 30 billion euro is also a big success. So just to name a few cases for all of you. Of course, there are numerous cases, but here already showcase that data analytics is really a powerful tool for us to utilize and also help us to solve real business problem. Okay, and because of time, my sharing is going to. I would like to conclude my sharing and really hope that you enjoy my sharing. Okay, first of all, is you can see from the first two slides, there is an exponential growth in data, the data volume. You can see we are using zettabyte, not terabyte to measure. Zettabyte is multiple times of the terabytes. And of course, unstructured data is dominating the data space. With the data volume and also with the variety of the structure of the data, so we see that there are huge opportunities. And of course, with these under this backdrop, we know that digital banking and analytics market are growing hand in hand. They have double-digit growth in the next few years. So that's really give us a big opportunity. But you can see from the survey, the values of data analytics are highly appreciated. People appreciate the value of data analytics, but we have long way to go to fully utilize the value of these powerful tools to us. And from the sharing, you can see that there are many useful cases, and of course, analytics has a proven record delivering real values. Today, we talk about the topic is I want to reinforce again, enhancing financial performance through data analytics. And I really illustrate that data analytics is powerful and really deliver real values to the firms, which I believe today is a great start, is a good starting point for all of us to explore data analytics. Hopefully, today I give you an overview of data analytics and how it has value contributions to financial institutions. And today we are not ending here. And for my sharing, I will have my colleague Brendan to share his viewpoint on it. And after that, we will have a Q&A sessions. Please, if you have any ideas, comments, and also any questions, please share with us. And I will pass back to Amelia after my sharing.
Oh, what a wonderful presentation. Thank you very much, Dr. Francis Lau, for the valuable insights. And I'm sure everyone's taking notes. And well, ladies and gentlemen, just as Dr. Francis Lau has emphasized that with various decision-making techniques, the growth of enhancing financial performance through data analytics truly reflects great opportunity and a shift towards data-driven strategies that have successfully and proven to empower businesses to maximize revenue. And it has also undoubtedly marked a significant advancement in the way that companies approach financial management, and it is up for us to keep up. Thank you so much, Dr. Francis Lau, for the great insights. And next, ladies and gentlemen, allow me to tell you a little bit about our next speaker. Allow me to read out his resume for you. So, ladies and gentlemen, Mr. Brendan Lagrange is a seasoned data analytics practitioner who possesses international working experience gained from global bank and information vendors. He has previously lived and worked in Africa, Asia, and Scandinavia. Brendan is now based in England, where he is the Chief Solution Architect at Confirm.U, an alternative credit scoring startup. He is also the creator of How to Lend Money to Strangers, a weekly podcast that challenges itself to find the world's most widely sourced lending insights. Brendan has strong academic credentials, a master in information strategy from the Northwestern University in the US, and a master of business administration from the University of Pretoria in South Africa. Well, Brandon, we're so honored to have you here with us. Can't wait for your presentation. The time is yours.
Thank you, Amelia, and indeed, thank you, everybody, for joining us today. It's an absolute pleasure to be speaking to you. I have had the honor of working and helping to launch the first ever credit bureau scores in the Philippines, in Thailand, in Malaysia, worked on credit bureau scores in Hong Kong and Singapore, but unfortunately haven't had the chance to visit your beautiful country in person yet. So until I get that chance to make that right, I'm just happy to be here virtually speaking to you today. I'm going to be touching on many of the similar themes to what my colleague Francis has touched on, but I'm going to be looking at it from a consumer point of view, and in particular from a business strategy point of view. So I'm going to start with talking about the data analytics landscape, and then talk about data analytics for consumer lending. Two topics, they sound pretty similar because they're really interwoven concepts, but what I'm going to try and do, and I hope makes sense as I go through it, is just touch on some of the background and how we've got to where we are today in terms of the data analytics landscape, and then also talk about how it might be different for your business. What I'm hoping you take away from today is that this is driven by a business. Every business is different, and just give you some things to think about and maybe how you shape your own data strategies. And then, as Amelia said, I run a weekly podcast and I really try and get people on that show from all around the world. I think I've had guests from 40 odd countries to date. And so I'm going to share some of the lessons that I picked up there, just maybe some names of companies you can look up and see what they're doing really well. And then I'll join Francis for the Q&A at the end. Before I get into it though, I'd be interested in running a quick poll as well, just to see what the level of comfort is with everybody in terms of credit scoring and credit modeling in general. So the poll is now up. If you select there just how familiar you are with working with scorecards. And I want to, while that's up and everyone's voting, just allow everyone to relax a bit, because I'm going to talk about scorecards. But I'll start by telling a little secret that I've worked for 22 years with credit scorecards. I don't actually know how to build them myself. The mathematics behind them can get scary. That's fine. I'm going to, as I said, talk at a business strategy level. I'm going to talk about why we use credit scorecards, what they're trying to do from a lending strategy point of view. If you're also unfamiliar with them, don't worry. Feel free to let me know. It also helped me to pitch that at the right level and maybe lead into some of the questions later on where we can talk about that at different levels. So if everybody can just tick there where they are, and maybe we can close the poll and just pop up the results quickly, and then I'll get into the meat of my presentation for today. So yeah, the poll is closed. I'm going to start talking through because we've got quite a lot of content to go. But to the team behind the scenes there, oh, perfect, they've already got it done. Okay, so 42% of people new to the field, another 34% that are sort of familiar. So that's perfect. I'm going to talk through at a level that's really for you, for the teams that are managing and thinking about what to do with that space. The 11% that work every day with it, we'll certainly touch on some strategies, hopefully, that are still useful for you, maybe some techniques to communicate to your managers and your other teams the value you're providing. But also we have the Q&A where we can really get our hands a bit dirty in terms of the technicalities. So I'm going to start with the data analytics landscape and sort of referencing this march of progress that we've seen. And the main takeaway I want to get from there is that we have walked, if we talk about the history of data analytics in lending, down a certain path, but it's defined largely by the data that we could afford at the time. So say that data we used was the data we could afford. I have a little caveat in there. I should probably say it was almost always the data we can afford, but just for simplicity, the data we used at any given time was based on what was available in the broader context. So we started this journey that we're on with in-house data. That was because in those days, back in the sort of 60s, 70s, and 80s, it was really expensive and really difficult to gather data. We're talking about manual records being pulled out and sometimes even paper records. I'm old enough that when I started working in the banks, there were still some paper forms that were being filled out and ledgers being kept within the banks that were completely manually entered. That meant it was impossible to do anything else than just see what data the bank had lying around. As we sort of got into the 80s, it became possible to start sharing some data, but still, it was very expensive to store data in a structured way, to create it every month in the same cycle, and then to share it to a third party. So what we did was we identified the data that was most important to share. And in the lending world, that's usually negative data, a blacklist of who has missed a payment in the past, who's a lender that we want to avoid as an industry. Often these were first shared just within small segments of an industry, maybe only credit card companies, maybe only the big credit card companies. And sometimes this was shared literally sort of in a circular path where everybody would just send around a list to each other. But it's also the sort of the typical credit bureau world where we all submit a blacklist to a central place and we can refer to that. What we realized over time as it became a bit cheaper to store data and transfer data is that the positive data, the rest of the data is very valuable too. Still, in the early stages, very structured, lots of hurdles. So we would only let the big banks participate or organizations we really trusted to have good data hygiene. And that was still not everybody in those days. But we could start sharing not just who missed a payment, but who made a payment. And then only from that point on, as data became more prevalent, became cheaper and cheaper, we started to see third-party data become available, telcos selling the data, or even government agencies providing things like utility payments and rentals. That was more not driven because we needed everything else in place, but simply because now, for the first time, we're really in a world where data is completely available to us. And now in the current stage, we've got open banking data where we can kind of log straight into a consumer's bank accounts and see exactly what's happening. But the point I want to get to really about walking this path is that we walk this path, but that doesn't mean that you have to. All of those options are available to you today. You can jump in right at the end and leapfrog the traditional sort of way that things were done. But also there's still some value in the old approaches. You don't need to jump straight to the latest sort of generative AI-driven models. I'm going to talk to you about how we think through where we should be aiming for and what different types of value we get from different data strategies. And with the big caveat or the big lesson here that all of those are different for different lenders and different markets. So here, and this is very much just a basic example to show the concept, don't sort of trust this as being the right numbers. But what we want to do is think about what data is available to us and how's it going to benefit it in different ways. I've got two simple axes here to think through. Is it predictive of high risk? And is it available for everybody? Those might be the first two sort of things. So let's do an exercise starting just with in-house data. So in-house data, is it available for everybody? No, by definition not. It's only available for our customers. But what does that mean? If we're a big bank and we've got a huge market share, our customers might be quite a big portion of the population. If we're a brand new fintech, maybe we don't have very many customers and our in-house data doesn't give us much coverage. But it also depends on your strategy. So some big banks will only lend to customers that already have a banking relationship, in which case of the relevant customers for you, it is a big portion. So you're going to think through for yourself, where does that fit? And of course, is it predictive of risk? Well, actually, in-house data is actually quite predictive of risk. And normally the problem with it is it's relatively small coverage. And then we want to plot in to the market, like what other data is available to us? How does it do in terms of, is it available for everybody versus is it predictive of high risk? And each of those, again, will change. So the credit bureau in the UK, where I'm based at the moment, 95% of people are on the credit bureau. It includes debit accounts. It includes all sorts of telco accounts, and pretty much everybody's there. In other markets like Indonesia, it's not a big coverage there. So those will move around. But importantly, also what will change or can change is what are you trying to achieve with this? So maybe your goal isn't that it's got wide coverage, but that it's cheap. Or maybe your goal is not that it's predicting high risk, it's that your goal is that it's predicting low risk. And those sound very related concepts, but what I want to get into here is the slight nuance in that difference. So starting with this quote from Carl Sagan, who's an American astronomer and sort of most famous as a science communicator, who used to say that absence of evidence is not evidence of absence, which is just sort of a nice way of saying that it's really hard to prove when something doesn't exist. I'll give one sort of last example there, that I'm originally from South Africa. My younger brother still lives in South Africa. And in fact, he lives in the Kruger National Park, which is our largest wildlife reserve, an area as big as Israel, where it's full of free roaming wild animals. And that means that there's always a chance that in the morning, if he wakes up, there's a leopard somewhere in the garden. He's got 3 young kids that play in the garden. So he wants to check that it's safe before they go out. So how can he see if there's a leopard in the garden? Well, if he opens the curtains and he sees a leopard on the lawn, it's easy. There's definitely a leopard there. But how does he know there's not a leopard? He can look on the lawn. He doesn't see a leopard. He can look in a tree. He still doesn't see a leopard. And maybe he can look on the jungle gym or 1 or 2 other things, and he'll be comfortable enough that he hasn't found a leopard. So it's probably safe. And that's the way that the traditional risk model works as well, that we can easily see if you've missed a payment. You missed a payment last month, you're probably going to miss another payment this month or in the future, so you're risky. But how do we see that somebody is low risk? The old approach, the traditional approach, is that we just try and get as much credit data as possible, and we see more and more occasions where you did not miss a payment. And the more we can do that, the more we say you're low risk. So if we sort of start here, we say, okay, who missed a payment this month? Okay, that's our riskiest customer. And then we start expanding out. We say, who missed a payment in the last 3 months? A few more people. The last 6 months, a few more people. Then maybe we say something like, okay, who's gone over their limit, over their credit limits? Okay, a couple more people, maybe some people that are not over limit but are approaching it. And we start expanding our data universe, looking for more possible signs of risk. And everybody who hasn't been flagged yet, we consider low risk. But what we have available to us now, and in particular, if we think of things like open banking, is a new way of doing things where we can actually see signs of somebody being low risk. With open banking or with in-house data, if you've got deposit accounts, or sometimes with third-party alternative data, is we can start measuring things like who's got extra money in their bank account, whose bank account rises every month, who's got investments accounts, who's got signs that actually they are low risk. And ideally, we can start building a model from both sides towards each other, where we're actively looking for people that are low risk, or at the same time, we're actively looking for people that's high risk. And I call this out not just because I say you should do open banking and this approach, but also to bear in mind, what is the purpose of the data you're looking for? If you're a lender that's looking for very low risk customers, you need to think about the data approach, and does the data you're out there getting actually help you segment among the lowest risk customers? So here I'm trying to link it to purpose. So what data do you need when? If all you need to do is crack some eggs, you don't really need a whole sledgehammer. You just might need a little bit of data to support you. So going back to that progression that we've seen, there's some incredible tools out there. The headlines are full of some amazing stuff you can do with machine learning and AI. I'll talk about some of that in a minute. But that doesn't necessarily mean that's what you're going to do. At the same time, I want to think of the flip side of that, the other way around. A lot of these tools have an amazing amount of insight they can provide, and we don't use it to the fullest. So I'm going to start here with a typical credit score. This is, in fact, a credit score for Confirm You, where I work, but it doesn't really matter what it is. What I want to show you is this gap that we sometimes see admitting, and as a consultant, I often see arising with clients. It's also where I get into a bit of the circular stuff I discussed in my introduction, because I'm showing you a credit score here. In a few slides' time, I'm going to talk about how we build one. So just bear with me for the moment. what we have here, this blue line sloping downwards, is the predicted default rate in our model. And every score along the bottom, the number doesn't really matter, but every score along the bottom, it's a unique score we generate. And for every score along that axis, along that continuum, a consumer has a unique probability of default. So in this case, over 300 different unique probabilities that we predict. And yet, very, very often, clients will ask me just, where should I make my cutoff? They have 300 different levels of fine-tuning available to them, but they just want a yes or no answer. So in this case, sort of here of the red and green lights, we've got hundreds of red and green lights, but if all they're going to tell us is lend or don't lend, then why have we got all these lights? Or flipped around, we've got all these lights, why are we only asking them to tell us one of two things? And that's a message I want to really underline, and probably the main message to take away is that the tools we have available give us a lot of ability to apply nuance. And unfortunately, I only noticed this last night. It was too late to change it, but the dotted line at the bottom doesn't look very dotted at all. It looks like two solid black lines. So I'm going to walk through what I'm showing with this chart now, but I do apologize. The lower line is the one that's supposed to be a dotted line. So starting in the middle, that black exponential sort of curved line in the middle is the same one from before. I'm showing you at every spot along that continuum, there's a unique probability of default. But when we're doing consumer lending, we don't actually lend, or at least from a strategic point of view, we're not lending to individuals, we're lending to portfolios of individuals, hundreds, thousands, 10,000s, hundreds of thousands of people at a time that we're lending to. So what we want to do is not just understand, okay, here's the risk of one individual, but if we were to make our cutoff at this point, what is the risk of the whole population that I'm letting through the door? And I'm just going to choose a point that's relatively easy to follow with the eye here and say a score of 400. So in this model, if a consumer has a score of 400, their probability of default is about 30%. 1 in 3 of them are going to miss a payment. However, when we think about making the cutoff, what we want to do is look at that blue line that's actually red on the right-hand axis. And that's the cumulative distribution of your population. So where do your consumers actually fall along this spectrum? Now, this is actual data from a bank in India that we work with. Your data would look very different, and that's the point. But in this case, 95% or so of their customers are less risky than that 400 marker. So because 95% of people are less risky, if you made your cutoff at 400, the very riskiest person through your door, the worst customer you would accept, they would have a 30% bad rate. But we want to actually drop down to that line that should be dotted underneath and say the benefit of all those good customers pulls down your average to where your population bad rate is maybe only 10%. Now, this is important because, one, we want to understand, like as we set our business goals, that what is the right risk appetite to have, that we don't turn away risky customers that we could actually afford to lend to. But it's also important because often we will hear the criticism that, you know, a bank only wants to lend to consumers that go over limit or touch their limit, you know, the profitable customers that are more risky. And in some ways, that's true. There's some logic behind that consumers that borrow more are more profitable. But the only way we can bring more risky, profitable customers on is by having lots of low-risk customers to pull that average down. So when you're thinking about your business and where you make your cutoffs, the profile, the clientele that you have on board is going to shift how you do that. And even if you and a competitor are both referring to the same central score, both sold by the same provider, you might have quite different cutoffs depending on, are you a premium bank looking for wealthy customers in the city, or are you a bank that's doing credit repair or doing risky new to credit consumers in the provinces? So we want to think about that. But then having said that, I immediately want to say, still, we don't want to just have one cutoff. And what we want to think about is risk appetite, not overall that the bank says I want to, or that the lender says I want to have a 5% loss rate, but rather that we think about it at a segmented level. So I'm not actually sure if TED Talks are a big thing in Indonesia, but they're online. You can find them easily on YouTube, so 20-minute long talks by experts on different topics. And one of my favorites is a talk by Malcolm Gladwell about the right spaghetti sauces. And what he talks about there is that his old job was to do customer surveys and to understand the market and help manufacturers decide what products to launch. And the old approach with spaghetti sauce had been to go to the market and get 1,000 people and ask them what they like about spaghetti sauce. And you'd see some people like it chunky, some people like it spicy, some people like it smooth, some people like lots of tomatoes, some don't. And you try and find the most average approach that's going to appeal to the biggest population. But what he realizes, we shouldn't be asking what's the best spaghetti sauce. We should be asking what are the best spaghetti sauces. Let's identify these segments and provide each of them a product that actually works for them. And we can do that with our lending as well. So referring back to the old faithful sort of line here of the scorecard in black, we are going to have a portion in red here, the top left there, that are too risky to lend. Fine, for whatever reasons, internal policy, regulations, doesn't matter. We're going to say no, straight out, you're too risky. But from that point downwards, we ideally want to get more nuanced. So the yellow in the middle are our typical average customers that we served one size fits all before. They can still get the generic general treatment. But maybe there's an orange band that's a little bit riskier than them. Traditionally, we might have said no to them. Now, maybe we can say yes, but at a different price. And maybe there's a green group below that we want to bring on board, that are sort of customers we really want. And actually, we can afford to give them a little discount if needs be to attract them to us. So this is called risk-based pricing. It can be quite difficult to do right, but it's quite important at least to think about it. And you can also be quite creative with it. So we talk about a discount. That could be things like a sign-on bonus. It doesn't have to be an interest rate discount. But that same segmentation approach can also come down to products. And often these should be bundled together. So you may, instead of saying yes, but at a higher rate for consumers in that orange band, say yes, but with a secured product. So yes, I can give you a loan, but I can't give you the loan in the normal way. I'm going to give you a loan that's safer to me. Likewise, for the green, you may not give a discount, but you may give them a platinum card or a better service, you sort of a standalone customer service team that doesn't have long queues to get treatment for. There's other ways of doing this, but ideally what we want to understand is who's applying for us, what are the products we have and the brands we have available to us, and how can we match those in the best way possible. And really, this is where open banking and alternative data can shine. So if we think about things like open banking gives us a view into a consumer's current account. I'm not sort of not actually that deeply involved in the technical side, but that's as much as we really need to understand that open banking allows a customer or consumer to say to you, I give you permission to see my bank accounts. And then you can look in there and you can analyze it. You can segment how much is coming in is a big win. Yeah. What is their salary? How much they're spending? But also where's that money going? And we know that, not all spend is the same. Not all spend is flexible. We can start to understand things at a much more nuanced level. And one thing I've called out in the points here is that is particularly important when credit cards aren't the dominant spend vehicle. So again, if we think right back to that first slide of the sort of advancement and progression that happened, we tend to follow the US when it comes to lending strategies and techniques that they have sort of the most developed market. Credit cards came to life sort of 40 years ago in the US and have always been the main way that people spend. Credit cards are a spending tool for the people that have them for the most part. We use them to buy things, but they had to be a credit tool because the infrastructure available at the time took a long time. So when you spent at the merchant would have to upload some data that day. It would have to get bundled up and sent into a bigger file at the bank and then processed. End of the month, they might combine it all and run a program to print out a statement. They would then send the statement in the mail to me. I would have to open the mail. I would have to write a check, probably put that in the mail, send it back. There was no way to do it faster than 40 days, 50 days. And so it became a credit product. For those 40, 50 days, the bank was lending me the money. But really, it was a spending tool. And now what we're seeing is data can go instantaneously. So e-wallets and debit cards and things are taking over. And as they take over, because those are not credit products, the traditional credit models getting more and more gaps. So we do want to make sure that we are having a way to see how consumers spend, where they're spending it on, from a credit point of view, but actually from a lot of other lending strategies points of view as well. And in particular, they can look at affordability really well. And affordability is an interesting one because in a traditional credit scoring model, we don't look at affordability. We just look at, do we think, statistically speaking, the consumer will keep paying the obligations they have today? There's an inherent and silent assumption that they can afford it. But we know in the world that that's no longer good enough. We need to see, can they afford this new loan? So that's what gets me excited about open banking in particular, but alternative data can do that same job depending where it comes from. Alternative data is such a big term that can be very different. Sometimes alternative data is just, did you pay your water and lights bill to the government? Sometimes it's social media data that has an exceptional amount of information in it. So that will vary on what we can do with it. And now, sort of slight change in speed, as it were. I'm going to start pulling it together in more practical terms with one more quote here, this time from Leonardo da Vinci, who said, if you want to learn how to see, you need to realize that everything is connected to everything else. And this is equally true of the credit world. I've got a second poll I'd like to pop up here that just asks where you are expecting you sort of what your priorities are for the next year, so we can get some sense of this. But while the team pulls that up, I'm going to talk about the interconnectivity of lending. What we can do is often end up in a lender that has siloed responsibilities. Marketing is its own business, sort of customer acquisitions from a credit point of view is its own business, and collections and such, and they don't often speak to each other. But in reality, every decision we make along the way impacts somebody else in the chain. So if we start on the far left here, the population, the dark gray, everybody who could conceivably take your product, some of them are going to actually apply for your product. That's sort of simple terms, marketing's job, to turn the population into applicants. But there's different ways that marketing can do that. If all they do is have somebody standing on the street corner handing out pamphlets, you'll get a lot of applicants, but they'll probably be quite low quality. So many of the applicants will get rejected by the credit models. If marketing do a much more targeted strategy, you will have fewer applicants, but many more of them will pass the credit models. But likewise, it could be going the other way around, that if the credit modeling team are building very strict credit models, and the brand is supposed to be a mass market brand that helps students get their first credit product, then the credit model is going to get in the way of the brand's goals. And I've seen this with a client who had a new scorecard put in. They came to us, they had some very expensive consultants and very expensive software they'd bought. They didn't feel like their scorecard was working. So I looked at some data. At the time, I had data that sort of looked over the whole industry. It was quite a nice data set to use. I could see that actually the problem wasn't their scorecard. Their scorecard was working very well, but they had the worst quality applicants in the industry compared to their peers. They were simply attracting customers they were going to turn away anyway. And what was more than that, I could see that half of their customers, that existing customer book, were dormant, weren't using their product. And those customers that were dormant were quite low risk. So what would happen is they were doing quite a good job of getting people into the bank. There was something there that appealed to consumers, low risk, good consumers. But then something in the experience went wrong. The consumers just didn't use the credit card, just didn't use the product in the end. So rather than trying to fix the scorecard, it was a case of getting your messaging right, getting your product right, so that the consumers you have are using it, and you can grow with those customers because they're much better quality than the ones that you're getting through the door. And so for me, we don't have time to do it today, but usually I spend most of my time just making sure that everybody has a coherent strategy when it comes to this. And it also impacts the data strategy. So where you are in that credit life cycle changes the sort of data that you would ideally have. Now, I say ideally because often we just have to use what we have available to us. But when we are strategizing, when we are thinking about data, it's worth thinking about where is it going to be used in the life cycle. So when we're acquiring new customers, somebody we've never seen before, we're looking to distribute our capital, but we don't have a lot of information, almost by definition. This is someone we've never met before. So podcast is called How to Lend Money to Strangers because that is a slightly silly thing to think about doing. You've got a consumer you don't know at all, very little information about them, and we're going to give them some money. So that's a different sort of data to when we're managing our portfolio, when they're already on our books and we want to say, maybe we can give them a second loan, maybe we could increase their credit limit, maybe we could change their price to retain them as a customer. And so that's why something like a low and grow strategy can be effective, where we say, okay, up front, I don't know you. I'm going to give you a very small exposure, very small loan for a short period of time. But if you pay that, I'll give you a bigger loan next time and a bigger loan next time, or bigger credit limit next time. And we can bring consumers on board with a strategy that acknowledges our gaps in data. And then we build our data as fast as possible so that we can give them the experience that they want. But it can also flip in things like collections. So when we get to collections, almost everybody is risky in a traditional sense. They've missed some payments. So now we need to think about our data differently. We want to think about, are there any signs about who's actually going to pay us back? And maybe some external data can be handy here again. Have we got a customer in collections that's not paying us, but we can see they're paying one of our competitors? That changes the way you would speak to them compared to a customer who isn't paying you, but they're also not paying anybody. They just don't have any money. So we want to think about, what is the data that I need for my particular role? And how does that change? Can I use the data that exists in the organization? Or do I need to go and look for other data types that might be out there in the market? All in all, though, there's one sort of driving message to the middle, is that the business strategy must drive the data strategy. So we need to be thinking about, what are we going to do with the data? And then from that, what data do we need? Rather than just taking the data that's available to us. And it will vary based on our business strategy. Are we doing large value loans, small loans, loans to new customers versus loans to established customers? All of that will change, and all of that will be variable and relative based on what you have already. Do you have lots of in-house data? Do you have a group, a conglomerate that has access to data on spend from shopping malls or hotels, or anything else will vary what's best for you. Now, as we build these data strategies and data tools out, we do also need to be aware of the gaps, of the blind spots that get created at the same time. So now I've got the image of the sort of the more literal take on the blind spot here with the view being blocked, but other times I talk about the credit rules we have as being like medieval city walls. So we build these defenses to keep out the riskiest customers, the bad payers. And we can build the walls thicker and taller. And as we do that, we keep out more and more of our bad customers. But those walls need to have a little gate in it to let the good customers in. And if we get too defensive, we make our defenses too strong. Sometimes we turn away customers that aren't risky at all. The gates we're leaving are just too small. And we've seen this happen in the developed world, particularly around credit bureaus. Now, I'm not trying to give credit bureaus sort of any stick. I've worked for many years in credit bureaus, and they can be very valuable tools. But just the bigger thinking here is that they developed, as I said, sort of from the 60s, really, but we started to see in the 80s and 90s and onwards, the credit bureau score becoming an inherent part of automated lending in the developed world. partly because of the credit cards as a spend tool that I mentioned earlier, but just everybody who was borrowing, everyone who was credit active in the US, the UK, was on the credit bureau. And it was a very quick bit of data to easily transfer around that gave you a lot of security to lend. So we built more and more complicated strategies based on it, and we brought more and more customers into the fold, and it became the thing that happens in lending. And that's great. It really helped empower most of the fintech accelerations and the digitization we've seen. But it does mean that those people that are left behind are finding it almost impossible to borrow. So they're a small portion, but because we've built everything around this one thing, we've left them outside the walls. So that could be young customers starting out their journey, immigrants new to the country, or just less economically active people that are now trying to make their first purchase. And I call that out because we need to think about risk mathematically, and mathematically an unknown variable is risky. Something you know less about is by definition riskier, but that's actually a risk that often we control more than the customer. If the customer isn't on the credit bureau, it's up to us really to give them that chance. They can't do it themselves. And so it's not the problem you will have in Indonesia, but the same sort of things can happen where we build a data strategy and we make it a core part of the business, and particularly when the whole industry adopts it, we can develop these gaps where we're leaving people outside the system. And it's not something that was well considered in the developed markets, and now only we're starting to see people really come up with creative ways to work around it. It's something you could think about right from the start and avoid that problem for you and consumers out front. And in particular, it's got some knock-on impacts that are not really spoken about enough, but should also be thought of in your data strategy. So going back to the traditional model in the West, it's, as I said, when we look at low risk, we don't have an indicator of low risk. So we just encourage people, we say, if you are low risk, give me more and more credit data that doesn't have risk in it, and then I'll reward you for that. So open an account that you don't necessarily need and repay it every month. Ask for a higher credit limit, but don't use it, just so I can see you don't need to use it. All these behaviors help mathematically. They help the statistics to say, okay, now I've got 6 credit cards, hundreds of thousands of dollars of exposure, and I don't use any of it. Yay, I'm a low risk customer. But actually, while mathematically I've showed you data that makes me less risky, in reality, I've become slightly more risky. It may not be, it may not impact everybody. Some people can operate very well with extra credit available to them and never touch it. But we can't avoid the fact that it is temptation. It is credit that's available to a consumer that might tempt them to use it, or even something just might happen and go wrong in their life, and they might use it and find themselves fully under the water and with no way back. And so I don't like that about the traditional model, that the way to manage your credit score works counteractive to the way to actually be a low-risk borrower. So one of the great opportunities we have when we work in new markets, and we've got a from the ground up start to data strategies, is we can align those incentives a lot better. And again, I'll call out open banking and alternative data here, but instead of using a credit card to spend, we can look at your e-wallet spend, and you don't need that credit exposure. And that, I think, is a fantastic opportunity to think through at the start as we build these out. Are we aligning the behavior that benefits our score with the behavior that actually benefits consumers? So very quickly, because I am sort of running a little bit late here, I want to talk a little bit about what a scorecard is, but mainly just to demystify it before we get into the questions. So what we're trying to do with a scorecard is, obviously, we want to predict the future. We want to see, can we say what's going to happen in a year's time? And the reality is nobody knows the future. So instead, what we have to do is we say, okay, let's use today as a stand-in, as the future, and say, if we were back in time 12 months ago, was there data available to us then that could have helped us predict what we're seeing today? And so we step back, we gather some data, and we're going to see, can we predict today? Now, that means inherently, whenever we build a scorecard project, we're looking at older data in this sort of quite common scenario, data that's as long as 2 years ago that's going into our model. And that's unavoidable, but something to bear in mind that as much sophistication as we put into scorecards, they're always behind the times. We do need to be very careful about that, particularly in a volatile world like we have now. And from that point, though, the mathematics is complex, but the actual concepts are very simple. So the first thing we do is we just want to define a target variable, which is like, what are we trying to predict? And usually simplified as a bad definition. So we're going to say, okay, a bad customer is 90 days in arrears in the next 12 months. And a good customer is not. Sometimes they're intermediates and a bit of both that we're going to ignore. Some scorecard builders use them, some don't. But either way, when we use them, it's just to ignore them. So let's just talk good and bad for now. We identify our groups, who's good, who's bad, and we look for shared characteristics within those groups. So is there behaviors and is there data that good customers share among themselves? Is there data, are there characteristics that bad customers share among themselves? And then we check that they don't share them across the groups. It's not just something common to everybody. Those become the traits that go into our scorecard. Now, we can do that with experts. We can just ask our teams or manual reviewers what they think, or we can start doing it mathematically. So regression analysis was what built credit risk modeling. It's still used very much today, still very accurate. But now we can also use machine learning and some more modern techniques. They're doing exactly the same job. They're just a little bit better at putting numbers to it. Instead of just a gut feel that says older borrowers are less risky than younger borrowers, we really can put a mathematical number to it. Then the scorecard, this one we've now seen many times, simply adds all those impacts together and says, here for this consumer, this is our expectation of their risk. I mentioned, modern data modeling techniques. We see a lot in the headlines, but primarily what's different is that regression analysis thrives in the very structured data world of the past, the data world that built credit analytics. Where machine learning comes, it can do the same calculation slightly more accurately, but mainly the uplift comes in that it can work with data sets that are less structured, more modern alternative data sets. So it allows us to bring new data on and model those rather than modeling better than the old techniques. If you're using regression, if you've got the data, that's fantastic. You seldom need to move to new approaches, but they can be a lot quicker.
Brendan, I'd like to kindly remind you that you have 10 minutes left.
Perfect, thank you. And then, what we're trying to do and we want to see as we measure it is just, can that scorecard separate good and bad customers so that we can do a business decision? So here I've got data from the Vantage score from the US. You've probably heard of the FICO score. The Vantage score is exactly the same, but less well known. Here we've got the distribution in red of the bad customers, the distribution in green of the good customers. Sorry, it's not very colorblind friendly, but essentially you can see on the left, 52% of the bad customers come in under a score of 600. If that was your cutoff, you miss half of your risky customers, and the cost of that would only be 8% of your good customers. 8% of the goods have a score of 600 or less. And the better your score, the further apart those two become, the less of an overlap you've got. And from a business point of view, the less you lose out for every bit of risk you avoid. There are mathematical ways of doing that. Given the time, I'm not going to talk about it because in the end, it is just that. It needs to come down to a lending decision that says, okay, what am I going to do with this? And here's from a different scorecard that we use, but the worst 10% of scores, those people have a 35% bad rate. The best 10% of scores, those people only have a 2% bad rate. Is that useful to me? Can I build a strategy from that? And yes, I can. I can treat the 1 in 3 people are going to miss on the one side. I'm going to treat them very different to the side where 1 in 50 people will miss a payment. I can see how to use that. It's useful. And that's really all we need to do. The fine measurement of a scorecard, the Gini coefficients and such, we can leave to our statisticians to worry about. So yes, the last 5 minutes, I'm just going to talk about some guiding stars we can look to around the world if you're thinking about aspects you may want to copy. And the first one I'm going to call out is the use of AIs and APIs. Now, I just said you don't have to have AI in your scorecard building. I think that's still true at the moment. But where AI is really useful is not so much the calculation side, but in all the data management that goes around a scorecard. So there's a German company at the moment called Tactile, a company closer to you called Finbots. They use AI to manage the data flows and APIs to connect data much quicker. When Francis and I were working and as youngsters building credit scores, we would have to get a production system to make a replica of itself, ask a data analyst to extract a table or create a table and extract it for us, move that data into an analytics piece of software, run our calculations for a scorecard, output the formula for that, then ask somebody else to code that into a test system, test it, and then put that out into a production system. And it might take 6 months, it might even take a year to get a scorecard from design into implementation. Now, that data, remember, was already 2 years old. So suddenly 3-year-old data is the freshest data you're using in your live decisions. APIs and AI mean we can do that in a matter of hours now. And that's where a lot of the focus should be if we're looking at AIs. How do we make the link between the decision, the thinking of a scorecard, and the using of that scorecard quicker? Second thing we can think of that's been done really well around the world is leveraging communities. So here I'm going to call out Just Lend, which is a British company, and Honeycomb Credit, which is an American company, that are both using people or community leaders as a way of understanding customers much better than they could have before. So if we think about lending to small businesses, some things Francis had mentioned before, the real complicated thing of small business lending is that every business is very different, and it's much harder to apply the same strategy to 2 small businesses than it is to provide it to 2 consumers. So what they do is they allow a business to create a campaign to raise money, but to raise money from their customers, their fans. So by them asking people around if they will back them, if they will invest, if they will lend to them, they're actually doing the work for us. They're helping us to find businesses. The only businesses that get supported are the ones that people on the ground support. They know it's a good business. They like that business. They like the products. So we don't need to worry about having thousands of staff around the country looking for good businesses. Their customers can do it as well. The third thing I want to call out is a British, South African founder. So I like to take some credit for them as well. Buy now, pay later called Zilch. It's Europe's fastest ever unicorn. They are Google-fying the payments industry. So they don't charge their customers any interest rates. Instead, they're using the power of their community to direct spend to certain partners. So they're essentially advertising and moving their customers to different areas where they will spend their money and charging the merchant an advertising fee. So there's new ways of thinking about credit as the old models disappear. And finally, the last one I want to talk about, because I know Data Culture does something similar in the region as well, but M-Kopa is a Kenyan secured loan provider. But what they're doing is they taking a new look on collateral. So they understand that with connected devices, we have the ability to turn on and off a service like a smartphone. We can turn it on and we can turn it off if a consumer doesn't pay. So they're making microloans to consumers to buy smartphones, to buy solar panels for their house. They're accepting daily micropayments for that. And should a consumer default, they can turn off the phone and essentially use that as the collateral. That allows them to lend to people they would never been able to lend to before. And sort of just wrapping up with this one as the last one, they have no data on these consumers at the start. But as soon as that consumer gets a smartphone, they're getting a wealth of data from that phone about the consumer. And very quickly, they're building up a database that they use to make bigger loans, other offers from to that customer going forward. And they can really expand so far beyond their loans because they've become a data provider. They've become the people who know their customers better than anyone else. And they can make other revenue streams by selling other products or making other service offers to those customers. So we do have a whole new way of doing the old things in the current world. And yes, I think I probably run a minute or two over. So I'm going to jump straight back to Amelia now and then join Francis for the Q&A and see what you want to ask in more detail.
Thank you very much, Brandon, for the great insights and knowledge and truly the landscape of data analytics and consumer banking. As Mr. Brandon Lagrange has stated and emphasized that, as you can see, it involves leveraging advanced techniques and also extract valuable insights from vast amounts of customers' data, and traditional data is risk-centric. Therefore, by analyzing market trends and customer behavior and tailored offering, this empowers them to make more informed decisions to optimize new ways of operations. So Dr. Lau and Brandon, we have received an exodus of questions for you, and allow me to read them out. So to our speakers. So the first question is from Bapak Sutarto Adi Sumarjo from Sinarmas Bank. And this question is directed to Dr. Francis Lau. Dr. Lau, and allow me to read out the questions. So at first, he'd like to thank you for the great presentation. He said it was mind-blowing studying the fact that the markets in Hong Kong are very advanced. However, in Indonesia, markets may be still far compared to markets in Hong Kong, in the sense that Indonesia's markets, many data are still in a different format, and it's also needed to it needs to be readjusted in order to be able to be analyzed or mass customization. So in a sense of cost and benefit, Dr. Lau, it will be very expensive if we don't collaborate amongst market players or need help from governments to create one. So how do you see this issue, and what happened in advanced markets like Hong Kong in the early stages? Dr. Lau.
Yes, I think thank you, Amelia, for the question, and also thank for the question. I actually, after presentation, I read that question. It's quite, I would say, quite inspiring. Even though in Hong Kong we face the same issue, Hong Kong may be more, it will be more advanced, but it's more advanced. I would say it's more advanced, but we still face the same question because the different in format, data format, or even different in, I would say, not just format, data definition is a big challenge to all the players. For example, let me give you an example. In Hong Kong, for example, what we how to define a bank account, maybe or even a transaction, maybe we have different implication to different players in Hong Kong. But if you want to leverage, like what Brandon has said, like in UK, we have open banking. In Hong Kong, we are also going to launch open banking. We definitely need to align on the definitions, on the and also the format. I think that's a pain which we need to address. I agree that's costly, and also that we need huge resources to invest in. But to make sure that we have useful data, we definitely need to go through the process. And as suggested, if there are some centralized party, maybe government or maybe some other organization, if they can play the role of a standard, like to define the standard, definitely will be beneficial to all the market participants. That's my view. So I think that's really a good question, but definitely that's a first step we need to address before we can unleash the power of data analytics. That's my view. Thanks for your question.
Thank you very much, Dr. Lau. Adjustments sure aren't easy. And so, Dr. Lau, what do you think are the key success factors for implementation of data analytics?
The key success factors is of course it's very easy to understand. First of all, because we are in because we're human. First of all, we definitely the success factor is people. We definitely need to have the relevant people in terms of skill set and in terms of the mindset, and definitely that will be of course a prerequisite. And how to do that is of course with the management. If they find data analytics is really useful, they need to push, they need to promote that within the organization, and also find relevant staff. And of course, the other part is about more on the technical side, about the technology and also the process. I think with that, I think we already have a lot of good devices and also good tools available. So with the people combining the tools, and if with all the data we have, definitely is a really important success factor. I would say these are all important to make it a successful start for a data analytics journey.
Got it. Thank you very much, Dr. Lau and Brendan. Of course, when we hear about the adjustments, especially in the early stages, and especially when we talk about the early stages, how would you introduce credit scoring for the first time in businesses? Brendan?
Yeah, so as I said there, you can really start these days with an expert model. And I think the important thing to think through is, yeah, it's usually better to start a project than to try and get it perfect. So I've done a project in Ghana, the first rollout of a scoring system we did there. And we started by, we got the software, we did a talk with everybody, what we're trying to achieve. We looked at the data we were going to start gathering. But at that point in time, there was no data available to us. And so what you can do are some techniques that are available for modeling just from an expert. So I won't go into details because, again, it gets a bit beyond me, but it's a use statistic, if you want to look it up, an unbiased statistic, where it's a tool that you take your experts, the manual teams, maybe the team leaders, the best get identified in the organization who have been there for a long time. And we ask them about the different scorecard, the different applications they've got. We look at who they approved and who they declined. And initially, all we try to do is replicate that in a system. In putting it in a system, we save ourselves time and we can automate it. We don't have to have so many committees overseeing, making sure people aren't making little manual mistakes. So we already benefit from that. And as soon as there's a system in place, we start to gather the data. So the actual analytical work can come in a year's time, and that can be quite quick. But the thing we can never avoid is time takes time. So if somebody pays you every month, you have to wait a month to see if they repaid you. There are parts that no matter the technologies, we can't avoid. So better to start it, get some of that data on board. I hope one of the messages that came through is that we have all this talk about generative AI and all sorts of complicated models, but actually a lot of the value of credit scoring comes in the simple versions. So we can put in place a data gathering project. We can start looking at people. We can get management asking questions, and we start gathering the data. And if in a year's time is the only time we start using actual statistics, that doesn't really matter to my mind. It's building that culture, and I guess referring back to what Francis said there, getting the people aligned, getting them on board. That takes time. Let's start doing that and let the analytics come when it can. But if somebody wants to leapfrog that, there are alternative data providers. Usually in the market, you can get some access to a scorecard. But as much as we can talk from a data point of view and say, jump straight in with a model, lending is a conservative industry. We want to make sure we're going to get paid back. So I'm in favor of testing a little bit longer, making sure everybody's comfortable before jumping right into a new model. But yes, start the project today. It won't seem so long in a year's time.
Got it. Thank you very much, Brendan. And of course, as they say, the first step is always the hardest. And Dr. Lau, any advice for a firm to commence, to start its data analytics journey?
Thanks for the question. To start with the data analytics journey, to echo my previous answer is, of course, we need to have the right person. We need to have the right technology in place. And of course, I think more important is for management of the company, they definitely need to, if they embrace the contribution of value of data analytics, they need to identify some hotspot, I would say, some hotspot to start with, like, are we going to grow our customer base? Are we going to manage our risk? Are we going to expand our market share? We need to find some hotspot. And then with that hotspot, we can find relevant data and also to apply some techniques to see if we can generate some results from there. If the first pilot, or I would say the first test is successful, then definitely we can roll out in a much more scalable way. I think that's a good, I would say, a test and learn approach. Nobody knows the answer unless we start with some testing and also to do some learning from it. I think that's the right, or that's the good approach to start with.
Thank you very much, Dr. Lau and Brendan. Of course, many of us are probably very curious to know your process. How would you credit score a small business? Would you also use the owner's details, and what kind of information would you also use for the business's detail, Brendan?
Yeah, it's an interesting question, and I think there's not a nice clear line when we switch from one to the other. But my philosophy in what I've seen on this in the past is that the consumer data is often easier to use and more readily available. When somebody's a small business owner, they will usually do everything they can to protect their business. So they'll use their personal credit cards, they'll take a personal loan, they may even miss some payments on that, but they'll be trying to keep their business going. So that means the information on the consumer side, any risk will come there first. So I do like to use the owner's details at looking at credit for a small business. And I like to do that as long as the business is small enough that the person is directly involved in the day-to-day business. So a few people in the business, I don't really know. Once it gets to 20, 30, 50 people, at some point it becomes its own entity. It's running independent on whether the owner is good with their money or not. But certainly the small businesses, that's true. At some point, there is a break. And so, yeah, if you're looking at a company with thousands of employees, the CEO or the owner is irrelevant. Lower down, I would definitely look at them. I may bump this to Francis as well, who's got some more, but I would always be using that for a small business. Medium-sized business, probably not anymore, but I can't give you a nice clear break at where that happens.
Thank you very much, Brendan. And Dr. Lau, you've mentioned strategic implementations, and could you also share with us real-life examples of how data analytics have been strategically applied to drive better financial outcomes?
Okay, so it's a good question. I can give you some idea about, of course, some examples I share in the in my presentation. But if you want to talk more about the strategic initiatives and also to get to the result is, I do have many examples. One of them I can highlight is all of you know Amazon. I think Amazon is a good case to illustrate. I think all of us buy from Amazon, and starting from the beginning, Amazon selling books online, and what they do is they just do a very they just do a small improvement. Like, for example, when I buy a book A, and then based on what they have is afterwards, when I buy a book A, they will their recommendation engine, they will provide you something like an email, and they say, oh, those who buy a book A will buy book C, D, E, F, G, something like this. I think you may have experience before. Just this type of small advice, which help to boost the sales of Amazon over 1 quarter, which is having multiple times increase in their sales and also their profitability. This is a really fascinating example to show you that if we find the right angle and more important is we can serve our customer better, helping them to find the products they need, definitely that will translate into reward to the company, which is financial reward, which is revenue and also profit. I think that's a really very strong examples I can quote to let you know data analytics really works in real world. Is that something I think that will be a very good example for us to follow. Yeah.
Thank you very much, Dr. Lau. Yes, Brendan, if you'd like to add.
Yeah, but I'll jump in there with one, and it's a very biased example. But when I started my career, it was with a company called Capital One. Capital One are an American credit card company primarily, and they, yeah, so I'm a bit biased, but they invented the modern sort of credit strategy approach. They were founded like the typical fintech story, just a long time ago, by a couple of innovators who were looking at this data analytics. They were starting to build scorecards. They were using a lot of test and learn approaches to see, does a blue envelope get opened more often than a white envelope? What's the best price to send? What's the best interest-free period to offer? They were wanting to do lots of tests and data analytics. And they traveled around the various banks trying to get people to get on board. Nobody took a bet on them until some very small regional bank did. They launched this business and they've become one of the dominant credit card providers in the US. If you look at the history of Capital One, now it is a bit old, so the approaches will all be different for a modern company, but growing out of in around the 90s, I believe, or might be the 80s, really is a story in the banking and the lending world of how embracing decision analytics built that entire company. So I said the philosophy, I think, is what you should take away. The approaches will be different today, 30, 40 years later, but they really changed the entire industry by understanding that if they understood their customers better, if they used data better, they could outcompete these massive banks. And yeah, they have done that.
Wonderful. Thank you very much, Brendan. And Brendan, this question is from our Q&A session from our audience. This is from Mrs. Anna Zufrida, and it's directed to you. And her question is, what statistical method is the easiest to use for processing bad rate data? Can you use logistic regression?
Yeah, logistic regression works really well. And if you've got a solid data pool, there's no real reason not to use it. And if you look at the credit bureaus, in most places around the world, that's what we're using the majority of the time. As I say, people will use some modern machine learning, AI type things, but they're very much a nuanced value add. 99%, and maybe Francis will correct me a little bit, but most of the work can get done in logistic regression. I would use that as the default for any early stage project. The time I would recommend looking at more modern approaches is when the data isn't very well structured. So when some customers have one type of data and some customers have another type of data, where we're using lots of big data that we don't quite understand, machine learning and AI can be really helpful there. But for traditional credit data, regression analysis is great. Bad rate data, if we're looking to summarize it, I mean, Excel is probably a little bit of an oversimplification, but the thing is, we don't need a very complicated tool unless we've got a very detailed business running off the back of it. So where we're looking to make 3 or 4 segments and we're looking to avoid the worst customers, reward the best customers, and treat the people in the middle with a bit of caution, logistic regression's already giving you more than you need there. So yeah, that's my starting point for anybody that's doing it for the first time, and in fact for most use cases.
Thank you very much, Brendan, for the great insights. And this next question is from Mr. Muhammad Sigit from the Finance Ministry of Indonesia. And this question is directed for both Dr. Francis Lau and Brendan. So let's start with Dr. Lau. So the question is, with working data analytics, what skills are needed in leaders or employees to conduct a successful data analytics? And how long will the learning process take? Dr. Lau.
Oh, yes, thanks for that. I think it's a really good question. And especially that's also, I think, relevant to Hong Kong market and even other market like Indonesia and even other markets in the world. First of all, we always talk about, nowadays we talk about data scientists. Data scientist is someone who have a strong skill set in quantitative skills and also understand the market and also understand how to do the coding. We always look from this, a typical example, quantitative, you have programming skills, and also you have domain knowledge. That's always a perfect example. But not every one of us have these types of skills altogether. and that's need time to build up. But from my perspective, from my own experiences, to become to build up the talent in this data analytics area, first of all, is of course we need to have that mindset. The mindset is very important, the attitude. If we believe in data analytics, we think that data is able to drive our business, drive the decision making, then we can find our ways. As simple as, for example, if we can put the data in we can group the data, we can look at it from different dimensions, we definitely can already find out some insights. That's something we call data visualization, which I think there are some tools already in the market which we can use to put the data and then to group them and then to generate some charts, and then we already can find out patterns. It's not rocket science. Every one of us can do it. So I think this is a starting point. And after we have get more of this data visualization skill set, then we can move on. For the statistical technique, why we need that is because, like what Brandon has shared, what is the, for example, logistic regression, or nowadays we talk about machine learning, artificial intelligence, or the buzzword, actually is help us to find the relationship, I would say the relationship between, for example, if we want to predict or you want to know whether a customer buy or not buy, then that type of model give us some relationship to understand what kind of information we have. Then we know the customer will react in this way. So we need that type of model, and that requires some understanding of statistics. Even with that, that also can be learned in the course of our work. I think that's what I have been in the past 20 years. I have education in that space, but while my job, I gradually accumulate that understanding and also the skill set. I think that's the path we are looking for. And for learning curve, I think from visualization, I think it's a few months, and then if you can really spend some time about 9 to 12 months, and you can have a basic mastery of the statistical concept and also the techniques to do your job. It's not something, I wouldn't say it's not something difficult. The most important thing is, are you willing to learn? I think that's the most important question I want to ask all of us. Yeah.
Where there's a will, there's a way. Thank you very much, Dr. Francis Lau. And then Brandon, with the same question, what skills are needed for employees to conduct a successful data analytics, and how long will it take?
Yeah, well, I was first say I'm delighted to be answering this with Dr. Lau, because interestingly, we both have held the same job, and we were very different backgrounds and different skill sets. So I'm going to echo first, from my point of view, it's a curiosity. It's a willingness to ask questions and to think about logical connections to things. That is the hardest one to train. So you're going to want to find people that are curious to find answers to questions. That's less of a skill set and just, a mindset. From that point on, you do want to do some technical things. So, I can say in the past, I've had bosses in this space. One was a chef. One was an explosives engineer from the mining industry. One was a ship's navigator. You can come into the market from many different ways, but I think where we are today is slightly different to when I started. And it is good to have a foundation in the basic mathematics and computer skills that are used. The good news is that much of that is automated these days. No code and low code solutions mean that you don't need to get very deep into the technical side to be able to apply the tools, but you do want to have that fundamental understanding of what they're doing and why. What's interesting is actually I'm phoning or calling in today from Edinburgh. I'm here at the University in Edinburgh at a conference on credit scoring, and one of the leading people in the industry from the US gave a talk yesterday. And he spoke about what he sees as the biggest danger for young people in the industry is losing track of why they're doing their research and making sure they're curious and understand what the models tell them. We're in a time when the tools can do a lot of the work for us, but we don't want to just push the button and then take the results and implement it. We want people that understand why they asked the question and interpret what the answer was given. So I would, probably similar timeline to what Dr. Lau said, maybe a year, understanding what the main statistical tools are doing. But also fundamentally, I know this is where my sort of different side of the industry might come in, but understanding more of the business side of that. Why are we doing these things in the lending world? What are we trying to achieve? Why are we applying the statistics? And what are we going to do with it? But it's not rocket science, as Dr. Lau said. It's not complicated. You may have one person in there who's really smart and understands the mathematics, but most of us in the industry don't need to get deep into the statistics. We don't need to get deep into programming. We do need to be curious. We do need to understand and ask questions about why the business is doing what it's doing.
Thank you very much, Brendan, for the excellent insights. And Dr. Lau, this next question is for you from Auzan Iqbal from Bank Jasa, Jakarta. And he would like to ask a technical question about the feature error contribution for scorecards. If I count only to feature importance and select top-end features with less correlation, and still it could impact on a bias to prediction. And he already evaluated R2, RSME, MAE, and p-value. So what is the optimal value to measure based on your experience, Dr. Lau?
Oh, I think that's really quite a very technical question about using the metrics. What mentioned about like p-value, like RSME, they are the metrics to evaluate the error rate. I would say there is not a strict rule or even a metric value. I would say a metric value to determine whether that is useful or not. And more important is, of course, we use that to judge the usefulness of certain factors or certain variable, or you call features, to predict. But more important is the result. I would say the result. Some of the time is if we find some factors or features which is really help us to find the answers, then of course in terms of statistically the error rate may be, or even the what we call the metrics may not be maybe a little bit margin, then we still want to try using that of course in combination with other factors. So there is no I would say there's no right and wrong answer to that question, but more important is judged by the usefulness and also the result. That's always the case. We are result oriented. In reality, we always try to drive using the results. Let me give you a case. Even if we have a if we have a model which is fulfill all the statistical criteria, but the result may not help us to drive our business to make better decisions or lower the risk, that may not be that definitely not a useful model.
Thank you very much, Dr. Lau. And this next question is also from Auzan Iqbal, related to model retraining. Instead of PSI, CSI larger than 0.2 and major updates of products, what is the main indicator to retrain the model based on your experiences?
Okay, so as I think that's a quite similar question as I've answered before. I think this person has a very strong technical background. Rather than answering from a very technical perspective, I would say to retrain a model is we always need to set our purpose and also the objective. I think that's a more I would say more generic answer to those building the model. Because at the end of the day, when we try to build a model, we always need to ask ourselves, what's the use of that model? Are we going to build a model which have all the statistical criteria, which fully satisfy all the statistical criteria? Is that our ultimate objective? If yes, then we definitely need to fine tune all the parameters and also to assure that the metrics are perfectly matched. On the other hand, from business perspective, The model build is, as I've said before, to help us answer the question, like to find the right customers, to lend to the low-risk customers, and like credit score, or even I want to find the good measured product for the customers. If this is the objective, then ultimately the model should help us to fulfill that. Then the criteria is this way, rather than, of course, I'm not saying that we don't look at the result. The most important result is the model fulfilling our objective. I think that will be the criteria, whether to retrain a model, whether to select a features, or whether to different alternative versions of the model. So this is my my point of view on it.
Thank you very much. Yes, Brendan.
I just want to add a little bit of that because it loops back to another question that was asked earlier. One of the risks when we move into the machine learning type space is that machine learning models are fantastic at finding lots of little relationships and building the models from that. But there can be a big risk in there of overfitting a model, that the model is too specific for the moment in time that it was built. And we can find that in the machine learning world, we're needing to redevelop models more often. It's not necessarily a problem because it's a lot easier to do these days than it used to be in the past, but it's something to be aware of right from the start, the risk of overfitting a model that may need adapting to too often. So this is less about the technicalities of when to redevelop a model, but one of the inherent benefits of kind of the regression approach is that maybe they didn't get quite as accurate at any one time, but they used to last a bit longer. So it's something to think about from a scorecard strategy point of view as well. When you're building, are we making sure we've not overfit this model? Is it taking into account a longer economic cycle? And just making sure that these retraining exercises aren't having to happen too often is something to bear in mind, particularly for people that are obviously much more closely involved in the projects.
Thank you very much, Brendan. And this next question is directed to you, and this is from Mr. Asari. So the question is, what do you think about using data analytics for consumer lending, especially in the midst of this uncertain economic times and the high inflation rate?
Yeah, I mean, so it's vital to do it, and more so when things are so changeable. So it is a bit of a strange situation where, you know, as I said, when you build a model, there's no escaping that the data is old. It has to be because we're looking backwards. When the current and particularly the future looks very different to the past, then that model is less reassuring. So made worse because if we look in the recent past, we've got COVID and all the changes that brought about. So we are in a period of time that's difficult on the one hand to model because the past doesn't very well reflect the future, but still it is the best approach that we've got. And one of the things we can think about is confidence intervals there and stress testing. So stress testing our models involves looking at consumers and seeing where would they be if interest rates are the easiest ones to do. If interest rates rise by a certain amount, how much does the cost of that loan come out? And using that in there, cost of living is a bit harder, but we can make some assumptions. It's often an approach that leaves consumers out because we might be a bit conservative in our estimates, but we can incorporate that stress testing approach. I think one of the things to bear in mind, though, and this is not based on looking at your specific data, of course, but usually what we see is, we'll talk about in scorecard terms, is rank ordering, that we want the people that we say are the riskiest person today, a medium risk and a low risk person, will be risky, medium, and low risk in all situations. The total level of that risk will just rise and fall. So usually what we'll see is when economic times are worse, we will see more people starting to miss a payment and things, but often the actual order at which they're doing it stays true. And often those customers that are low risk will keep trying to pay and making the benefit. So it's hard to balance that. You do want to be conservative. You do want to avoid the losses. You do want to avoid giving credit to somebody who's not going to pay back and then be stuck trying to make the payments. But often people get through tough times better than we expect. Regulators don't take that as something that they will accept. So you have to build your models cautiously, but usually people get through better than not. And one last thing I want to talk about here is when we look at economic crises or recessions in general, it's the consumers. I'm going to use some American terminology, but we'll talk about subprime borrowers, the riskiest borrowers according to sort of credit statistics. These are consumers who all through their day-to-day lives, whether the economy is good or bad, they are always just a day or two away from losing a job, just a day or two away from missing their payments. These consumers actually do quite well in a recession. They're used to finding ways to survive in tough times. So it's not normally our riskiest customers that cause problems when the economy starts to dip. They are most creative in finding ways to get by. It's the lower risk consumers who've never had to deal with difficulties like this in the past that do default. So if you've got a loan portfolio that targets sort of middle income and higher consumers in the big capital cities, you don't get away easy just because your customers are low risk. In a downturning economy, those customers are perhaps the first time in a while experiencing a pinch and can start to default. So everybody should be aware of it. Everybody should take it into account, but I'd say don't panic. Certainly do look at the data you've got available. It's history that is a bit old. It doesn't necessarily reflect the future, but build that into your assumptions. Give yourself a bit of leeway at your cutoffs, perhaps, but try and keep as much data as possible in your exercises rather than just the gut feel.
Thank you very much, Brendan. And this next question is for Dr. Lau. It's actually for all speakers. So Brendan and or Dr. Lau, please don't hesitate to jump in. And so the first question is how to manage back customer data that has been protected by GDPR law or private data protection due to compliance concerns on data collection. We'll maybe start with Dr. Lau.
Okay, so I think the first, actually we are in a very regulated market, like in the GDPR, I think apply to some countries in the world, and also in Hong Kong, we also have very stringent data privacy law. The first part is, of course, when we want to collect the data from our customers, we need to get, I think the important part, the spirit of the law is to get consent from the customer. That means when I apply for a loan or even I apply for different products, then I need to give the consent and provide the and allow the organization to collect my data. And of course, I think that's at the beginning, the design of how to collect the data is to fulfill all the requirements. That means to get the consent and also to state which piece of data you collect from the customers, and also fulfill the retention and also the usage requirement. I think that's of the most important. That needs to be embedded in the data collection process, where I think nowadays is electronically. If we can embed all this requirement, we can still get the data and also use it for analytics purpose. I think that's the angle how I want to offer to how to address or how to cater for that requirement. I think ultimately the law is not to prohibit the collection of data, personal data. It's not to prohibit, but rather to make sure that the data are collected in a legitimate way and also to use in an is used for the purpose is stated. I think that's my response to it.
Thank you very much.
Yeah, and I'll echo that consent is key, and one of the first steps if you're thinking about doing a project is to start getting that consent now, because that is a process that can take a while. But the good news is I've just heard from a client who did an open banking project. They currently get 80% approval or consent rate. So 80% of consumers they ask for consent for open banking will give that consent. So consumers are happy to do it in the right situations, but you need to change all your application forms, you need to change all your lawyer stuff. So even before you're able to gather the data, it's good to start those processes. One of the difficulties it does present is, I spoke a lot about the benefits and what I see as good things about open banking going forward and alternative data. One of the risks with it is that, at least in the implementation in the European GDPR, is that the consent can be once off, which lasts for 90 days, or it can be ongoing. But most of the consent is given as a snapshot. You've got access to that data for 90 days. That means you can see open banking, you see 2 years of history of the open banking, but next month you don't see that data refreshed. Whereas in the credit bureau world, we would have the same data going on and on every day, and we'd have years of data for everybody. It's more a collection of snapshots in an open banking world, which can introduce some complexities. And when you need new data, you need new consent. So it's something that needs a very clear thinking about. It's ultimately a good, we can share data, we use tools to anonymize and share data, but it does mean gathering data can be a problem. And we have to use our compliance team so often to write the right things in terms of gaining that consent. I'm just going to talk about one other slightly related but nuanced aspect of that. In the data protection world, we also have the problem of how do we avoid bias, and in particular, when we're looking at things like machine learning and AI models. It's a popular question, but we have certain protected data fields that we're not allowed to ask a consumer about, but we also want to make sure the model is not biased. And it can be quite difficult to know if your model is not biased against, for example, gender, if you're not allowed to ask somebody's gender. So there is an ongoing discussion between regulators and banks and all parties involved in how do we prove to ourselves, to the regulator, that our models are unbiased if we're not allowed to ask consumers for the data that we need to test against. And there's no good solution yet. It may be that once a year you can ask some people for that data, but it is a related problem that comes in this desire to protect people's information, which is a good, we've seen enough data breaches to know why that's in place. But there are still ongoing complications on how do we get the best benefits for individuals and for societies while keeping data safe. So for the most part, 99% of your day can operate fine. There are ways that are getting consent and customers are willing to give it, but it does introduce some new things to think about. And if I look at my career in 20 years, the biggest change for me has been the growing role of compliance. Probably the biggest team now anywhere in my clients is the compliance team. And in Europe, a big part of them is GDPR. So it is something that does need active management. But other than that, is working quite well.
Thank you very much, Brendan and Dr. Lau. And this next question is also from Hudan, from a bank BPD Yogyakarta. And this is still on compliance concerns. And allow me to ask Brendan to first answer the question. And a comprehensive prediction and prescription analytic on business intelligence, analytic, and data science comes from multidimensional unstructured data collected from social media, web, customer data, text mining, which is likely some of those data are protected data by the law to be processed with machine learning to provide prediction and prescription to the bank. So is it possible to use apps like Power BI, Tableau, or other cloud business analytics services apps regarding this compliance concern? Brendan.
Yes and no. I'm going to also slightly cop out and say that the specifics are probably something we need to look at more carefully before giving a real prescriptive answer here. So I'll talk a little bit more generally, but yes, it's a big problem with big data is this overlap with compliance and the ability to prove and know consent, and that's ongoing consent. So we have seen many projects where lenders will opt not to use social media data, not to use text scraping data. Markets like India have banned some text scraping data, and depending on where you're sitting in reputational damage, you will sit further or closer to the line of what's allowed. Where data is not allowed, obviously by regulation, it's not allowed. But even where it's not specifically not allowed, it can be difficult. That said, it can add a lot of value, and there is a balance there. If it's the only data you've got, and it's a difference between making financial services available to someone and not, it might be the right thing to use. So can you use Power BI? Can you use other AI tools? Yes, there's some good categorization tools that can, read through the data, try and identify what it is, try and help you incorporate that, take messy data and give it some structure. And also tools that can help you model, as I said, like the real big benefit of the latest techniques is modeling a portfolio where some people have Netflix data and some people have Facebook data and some people have bank data and some people have something else, and working out little micro patterns and combining them. So the tools exist to do it. It's feasible. And there's tools that get better every day to help us stay as true to the data rules as possible. But I would always be a little bit cautious, both on is it allowed, and two, on whether or not the consumer would be happy with us using it in that way. So that comes back to the consent. When we consent to the data, there's the fine print of what we're consenting to, but we do need to bear in mind like what the consumer realistically expects. So we have, as I said, seen lenders that would not use social media data just because they think the reputation risk is too high, that somebody would get upset about it, or that in some way it might be linked to a bias that they didn't know. The fear of black box machine learning models is not as big as it used to be. There are a couple of good tools to explain how AI models have come to where they are. You do still need to be cautious because you can indirectly be inferring things based on fields that aren't protected. But we're getting much closer to a world where we can manage that. So I'd say it's possible. I would be careful with it. Fields that are protected should be excluded sort of as soon as possible, just so that there's no risk of it accidentally being pulled in there. The other ones, yeah, there's tools out there to help you use screen scraping. They were huge and very and effective in India. The open banking in some ways is just a better way of doing that screen scraping. So it's possible. I'd be careful, but there are times it's worth that risk.
Thank you very much, Brandon. And Dr. Lau, would you like to add on that?
Yes, I would like to give a perspective from I would say a technical perspective, because let me put it this way. I think to mitigate that the privacy concern is, of course, every organizations, when they collect the data, there is a consent. Of course, that's the first way. And also for the data analytics, actually, as a data person, actually, I work for banks for many years in this area. We don't need to touch on we call personal identification information, the PII. We don't need to. For example, if we want to analyze the purchase behavior of customers, we don't need to know who is Brandon, who is Francis, and who is Peter John. We don't need to know that. We just need to know the customer's behavior. And for those types of information, for the analysts, for the analytic teams, they don't need to touch on. They just know that's a customer with certain ID, which is to separate between different customers. They don't know which one belongs to Francis, which record belongs to Brandon. I think that will help to mitigate, because we look at is aggregate data. We look at the patterns. We look at different groups of customers. We don't need to know individual identity. I think that's you can say a mitigation from an analytics perspective, to take away all the identification data, and we only look at the behavioral, the transaction data from different individuals. I think that's one part to alleviate the concern on privacy. That's what I think you can say best practice of doing analytics. That's one angle I want to I want to offer.
I apologize, I was on mute. Okay, so Brendan, yes, this question is from Mr. Muhammad Ferdiansha, and he would like to ask you regarding scorecards for SME products. What is your view on that? Especially since nowadays there are many banks that are utilizing scorecards to underwrite SME customers, where the scorecard itself was built using very limited set of bad population. Therefore, is it safe or not to use models that are built in such manner?
Yes, so that's actually, that's a good point. The scorecard builders love seeing bad accounts. That's usually how we have to build scorecards. So the more, when we're building scorecards, we want defaults because that's what we're modeling for. SME scorecards, I think, is where some really big changes have been happening recently. So if we think about the old days, to measure the SME, we would have very little data other than who they are, the industry they're in, and then things like their turnover and their revenue. We would need to get an accountant to create financial statements and then have them reviewed and sent over, and they'd be very old. Now what we have is a way to get that data much, much quicker. So I've seen, there's a company, for example, called Settle out of the US. They started as a accounting software, which I still believe they provide, but they put software into a company and then they use the back end of that software to make their lending decisions. So they've got an immediate view of where that SME is making money, where it's spending money. And we see Wayflyer is probably the primary name on that, but Dr. Lau mentioned Amazon. This new world of e-commerce, there are a lot of revenue-based lenders that will look at your Amazon account, will look at your Shopify account, and we'll see on a day-to-day basis how much you're selling and use that to lend. It's a much more data-rich world than it used to be. So anybody who's got an older SME scorecard, I'd say now is a great time to look at rebuilding because you will have a lot more data available to you than you did in the past. As to the bads, that's still going to be a problem. So most of these consumers, most of these SMEs, hopefully, are still repaying you. So you're still going to have that lack of risk. The only option we really have there, well, there's some statistical techniques that can emphasize the bad customers a bit to help us in the modeling process. Or we've got the option of changing the bad definition where we can lessen what we consider a bad. So instead of saying someone has to miss 3 payments, maybe it's 2 payments, maybe it's 1 payment, maybe it's only over limit, or maybe it's some other expert judgment on their revenue numbers. I've seen some people talk about predicting the revenue or the bank balance direction rather than a default. So there are some ways to get around the lack of risk. Unfortunately, that is sort of a core part of modeling, and something maybe it's more something worth looking at in your case by case. But more generally in SME, it is a much more data-rich world than it used to be. And so if you're thinking about a new scorecard, it's probably a good time to have a look and see, do you have much more data now than you used to leverage?
Okay, so I want to supplement on this question because in Hong Kong, we are also working, I myself also work on a number of initiatives to support banks in the SME credit scoring area or credit rating area. Of course, the nowadays, I would say what Brendan has said is quite true, is we used to have limited information for SME, especially the financial information. The quality are very, I would say, very diverse. But nowadays we have all the e-commerce and especially the payment data, the commerce data, e-commerce data, and also other trade finance transaction data. With all these, we can actually understand the operations or the business volume activity of SME. So I think that builds a very strong foundation for developing SME scorecard. I think that's the supplement I want to highlight, because in a market like Hong Kong or even some other developed countries, that's the way to go. I think that's an echo and also supplement on this one.
Thank you so much, Dr. Lau and Brendan. Thank you so much, everyone, for the great insights, and thank you to our audience for the great questions. Unfortunately, due to limited time, we won't be able to do all the questions. So before we end today's webinar, I would like to kindly ask our speakers, Dr. Lau and Brendan, to deliver your closing remarks. Allow me to welcome Dr. Francis Lau to start.
Okay, so first of all, really, let me thank again for OJK and also LIBF for giving me this chance to share my views and also to answer questions from the audience. As said, there are too many questions for us to answer. We should have another 3 hours, but the time is limited. But to conclude my my sharing today is I would use some keywords to link together. First of all, is data. We definitely see a huge volume of data coming from different perspective, and with the diversity of this data, we have a lots of inputs to use. And of course, with the advance in technology and also in quantitative method, we have all the platform, and we have all the methodologies like machine learning, AI, to process this data. I think the ultimate question is how do we use this data and also this method to bring to the table to solve our everyday business questions, whether it's from marketing, whether it's from risk, whether it's banking, and I also some question asking about insurance. We definitely have a very big area in using data analytics in general insurance and also life insurance, which I think is a big topic. We can definitely find time to talk about this later. And that's why I think nowadays is a really good time for us to act, rather than we just sit here. It's a time for us to act, and also to commence, as one of the questions, to commence our data analytics journey. So that's my concluding remark. And I would say we will do. We don't have the best solution now, but we will gradually doing much better and better. So that's my my viewpoint. So act now. My 2 words. Act now.
Thank you very much, Dr. Lau. What a great anchor message. And now, ladies and gentlemen, allow me to ask Mr. Brendan Lagrange to deliver your closing remarks.
Thank you very much. Yeah, I love that. Yeah, act now. I think that echoes some of my thinking as well. It's an exercise that some aspects take time and it's unavoidable. So the sooner we start, the better. But I think my closing message is just that the core thing to remember is that we're lending businesses, and we need a data strategy that helps us to lend better, not a data strategy that helps us to do analytics better per se. Analytics are fantastic. They can really help us make better decisions. They can help us measure our decisions, and that can translate into better lending, but there needs to be that strategic link. So we want to think holistically about the business, make sure that everything from the brand to the collections team are working towards a similar, or working towards the same lending strategy. So start as a business, think about as a business, ask business questions of your analytics teams. Think about how you're going to grow, how you're going to serve your customers better. And when you've got that understanding, look at what data you need. The good news is we're in a world where that data probably exists, that tool you need probably exists. So if there's something you think can help, look for it, bring it in, test it. If it's working, use it. If it's not working, get rid of it. But embrace the curiosity, embrace the experimentation, and tie it to your business. And I think that's where I'm going to leave it. As Francis said, it's been an absolute pleasure. Delighted with how many questions we've had. Feel free to reach out directly afterwards if we've got questions we weren't answered. But yeah, I've had a great time. And yeah, I hope to speak to people on the forum again one day.
Thank you very much, Brendan, and thank you, Dr. Lau, for the closing remarks. And ladies and gentlemen, so on our subject today, enhancing financial performance through data analytics, it has truly enabled businesses to make informed decisions in areas such as investment allocation, revenue generation, cost management, as well as risk mitigation. However, while it offers immense benefits for enhancing financial performance, just as Dr. Lau and Brendan had emphasized, let us also not forget that careful planning and responsible practices and holistic approach that considers technical, ethical, and organizational aspects remains the key to its success. And now the $1 million task for everyone is on balancing automation and human expertise. Organizations will really need to strike a balance between relying on data-driven automation and the expertise of financial professionals for decision making. Once again, we'd like to sincerely thank Dr. Lau and Brendan for the great insights, and I'm sure that everyone has gained incredible insights from them. Thank you very much. And ladies and gentlemen, we'd also like to thank everyone here for your participation and attendance here today. And to count, there are almost 9,000, yes, 9,000 or 8,715 people who had registered, and around 5,000 people had attended this webinar on Zoom. And from the banking sector, around 47% of you, and on banking financial industry, around 26%, and OJK, around 3.4%, academician around 4%, and capital market sector almost 5%, and others at 8%, and government agencies at almost 6%. Ladies and gentlemen, please don't forget to click the link for the feedback form and materials from both speakers that are available on this chat feature. And please also complete the form before we close the webinar as a requirement to get the e-certificate of attendance. We would like to inform you that OJK Institute had launched the mini site of OJK Institute that will provide access to various information regarding the financial services sector, such as capacity building, professional certification institution, and innovation and visionary research. For details, you may visit ojk.go.id, OJK Institute, or you may scan the barcode on the Zoom screen. And ladies and gentlemen, we'd also like to remind you that we have shared a link for the feedback form on the chat feature, and please fill it out before Friday, September the 1st as a requirement to get the e-certificate. You may also access today's materials through the link. The material and recordings at the OJK Institute mini site can be opened in the capacity building menu. Then choose the Enhancing Financial Performance Through Analytics Data webinar. Then everything will appear on that page. And ladies and gentlemen, OJK Institute invites you to join our webinar Pemanfaatan Internet of Things, or IoT, di Industri Jasa Keuangan on September the 14th, 2023 at 9 to 12. The webinar will be opened by Bapak Hassan Fauzi as the Chief Executive of Technology Innovation, Digital Assets, and Crypto Asset Supervision, concurrently member of the Board of Commissioners of the Financial Services Authority. And the speakers will be Bapak Teguh Prasetya, Ketua Umum Asosiasi IoT Indonesia, Bapak Toto Prasetyo, Director of Technology and Operations of PT Bank Negara Indonesia Persero Tbk, Bapak Iman Sentosa, the Director of Technology and Operations of PT Bank BCA Digital, and Bapak Hanang Setio Hargo, the Vice President Enterprise Product Management of PT Telekomunikasi Seluler. And ladies and gentlemen, OJK also invites you to attend a workshop Penerapan Artificial Intelligence pada Data Analytics di Industri Jasa Keuangan from the 26th and the 27th of September. Registration will be closed on the 8th of September. And for those of you who are interested in joining the workshop, you can view further requirements and register through the OJK Institute mini site on the capacity building menu. There are quota limits for workshop participants, so OJK Institute will contact the selected participants and announce them through the OJK Institute mini site. Then para insan OJK, you may also make use of the OJK Digital Library or e-library through the link elibrary.ojk.go.id. And make use of it, ladies and gentlemen, as it provides various types of books that can be accessed by the OJK internal and external parties. You may directly access eLibrary by the login using the office email and password. And for external parties, you may first register your account through the register menu, and all has been made easy on OJK eLibrary. And meanwhile, OJK Institute has also proudly launched the Knowledge Management System of Human Resources in the Financial Services Sector, or OJK Synthesis. OJK Synthesis aims to create a collaborative and inclusive learning ecosystem for all human resources in the financial services sector, as well as to improve learning effectiveness with a structured curriculum according to the needs of the industry. So for more details, please visit the link on synthesis.ojk.go.id, or you can also directly scan the barcode on the Zoom screen. And to keep up with more, ladies and gentlemen, you may also follow our Instagram, OJK Institute. And we have come, ladies and gentlemen, to the end of today's webinar. And once again, on behalf of the Indonesia Financial Services Authority, or OJK, allow me to once again thank you for joining today. Thank you for your participation and attendance. And we hope to see you again on our next event. Thank you very much, everyone, and have a great rest of the day. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh. Om Shanti, Shanti, Shanti Om.
Thank you so much, Dr. Francis, Brandon, and LIBF team. Terima kasih banyak, Mbak Amel. Thank you, Kari. Thank you, Lee. Thank you so much.